think, please confirm if you can hear me now, Albert, and the rest of the online members.
I can hear you, sir.
Okay, perfect. Thank you. So I was saying that I'm just going to talk about a few things that I believe we already know, and we already are preparing towards the 8th of December, 2 p.m., right? 8th December, 2 p.m. Okay. Now, one of the things I request of us to do in this session is to listen. So those of you who would like to note down a few things, depending on whatever you listen to, feel free. And then also participate as much as possible, ask questions where need be. And then we may hint on a few sample topics just for sampling basis. So enable us. So the first thing I'm going to do, I'm going to just walk through the whole syllabus once again, okay? Just to see. I believe all of us, depending on whether we study from, whether here or other colleges, you've covered the whole syllabus. Okay, because that's the first important step towards passing. Okay, it is covering the syllabus, knowing which topics that you have as per your syllabus, and then secondly is how do I integrate one topic to the other? How do I integrate various topics, especially topics that marry in one another? Because there are some topics that you really look through and you realize you need to devote some more attention towards them as you read through. So I think that is it. In case you feel that I am too speedy in any way, please let me know, and I'll be happy to slow the pace. Now, maybe before I begin, do you have some expectations? Feel you prefer this session to meet? You have some expectations? Please feel free, listen, just interrupt me. Yeah, feel free. Okay. Let's move on. Now, your syllabus for financial accounting paper 1, of course, covers various sectors or sections. So I'm going to hit on a topic and we discuss as we move on like that. Then, of course, as you have questions in between there, you can pose them. Now, importantly, this paper or financial accounting paper 1 is one paper that honestly all of us should be able to pass at the first attempt. What I mean is that the first time you sit it, it's very important that you pass it. And the principles that you learn in this paper, you carry them to various papers on level 2 and level 3. Okay? Paper 1 feeds into financial reporting. It feeds into advanced financial reporting. It feeds into public financial management. You can see all those papers come from this paper. So we need to really understand some basics, because at that level, some topics that you will not see being taught again, but you will be expected. For example, double entry, debit and credit, right? So being said, now, of course, you need to understand that financial accounting is a branch of other accounting sectors. For example, the cost and management, so cost and management accounting, and then other forms of accounting. Now, candidates at this paper focus more on computation and you neglect the theory. I believe if you've taken a walk through the various topics as you've been doing, the various question papers and yes, as you've been reading, you'll realize or you'll figure out that there are some questions that have some bit of theory, which for me, I consider them to be free marks. Okay, maybe 1 or 2 on the question, or 4, depending on the mark allocation. It's very important that as we read, as we prepare for our exam, we don't just focus on the computation bit, because you'll be losing some marks if you neglect the theory. Now, as much as you prepare for your theory, there are some theory things that may seem as if they are easy, or you may say, these ones cannot be asked at this level, and they may actually be asked. For example, things like the conceptual framework. Okay, the conceptual framework. You need to know at this level, as we are left with how many weeks? 2 or 3. We need to know what when a person says elements of financial statements, what do we mean? When a person says, can you define by definition the elements of financial statements? Okay. When a person talks about the recognition criteria, the measurement criteria of the elements of financial statements, do we know how they are? Yeah. When a person says, can we distinguish between certain source documents? For example, do you know the difference between an invoice and a quotation, for example? Because what happens is they may not necessarily ask you to define what's an invoice, okay? But they may bring it in a question, maybe, Sarah issued an invoice worth 100,000. So they may give you like a line 3 or 4 as a background. With examples, explain the features of an invoice. And the worst thing is that you've ever seen an invoice before, but because it's an exam, you tend to forget that is, yet it's what? It's the same invoice. And make matters worse, at times you're even some of the people who issue those invoices, maybe at your places of work. But an exam setting, you may forget actually what could be some of the features of an invoice. I hope I'm tickling your mind on some things that you may consider them as basic. So that is how they may ask you some of the theoretical things. The accounting process, can we know, or can we, in chronological order, can we state what the accounting process is? Yeah? And you may see it as something small, and then you leave it like that. In your objectives, of course, you may see some of the theoretical things that are in your literature as you read, but there are some things that may come. Let me give an example. If I told they asked you a question that financial accounting is used by both internal and external users, can you distinguish between the internal users of accounting information and the external users, yeah, and their information need? Are we getting that? Their information need. For example, if at all I say employees are some of the users of accounting information, what would be their need? For example, why do you think employees may be interested in financial information? Why? Let's interrupt as much as possible. So, why do you think employees may be interested in accounting information? Okay. She says that they may want to know if maybe the company is able to continue paying their salary. How do you know that? How can you tell that the company is going to, or is able, or will continue to be able to pay your salary? How? Yes, please. By looking through the statements. That is the statement of profit or loss and other comprehensive income. Is the company profitable? Because those are some of the decisions that, so those are some of the items that the company, that the employees in this case may be interested to see and try to find out if they can actually continue being part of this organization. So things like that. Okay, they can ask you that kind of literature. So please be able to have. And then there's one that normally is in the conceptual framework. What could be some of the qualitative characteristics of accounting information? Qualitative characteristics of accounting information. Yes. So you feel like you want to say something? Hmm? What could be some of the qualitative online guys? Please, you can unmute, you can contribute, and then you mute yourself again so that we can keep the session as interactive as possible. What could be some of the qualitative characteristics of accounting information?
Relevance.
Yes. Accuracy. No. Someone online said
Relevance.
relevancy. Now, just for context, we need to know these qualitative characteristics of accounting information are categorized into two. Okay, they are categorized into what we call the fundamental characteristics and the enhancing characteristics. Yes. Now, that is the categorization. Now, under the fundamental, we have faithful representation and what else?
relevance.
And relevance. Yes. Now, you also need to know what each of those means. Okay. Then for the enhancing characteristics, we have comparability, we have verifiability, we have understandability, we have timeliness. I hope I'm not dictating like I'm teaching. I'm just hinting what I believe we know at this level, right? I'm just tickling our minds some of the things that we need to prepare for. Together, but in case still I'm fast, please let me know. I'll slow down. So you may see that as something really basic, but when you're fighting for 4 marks, yeah, it is important, right? Because the 4 marks reduce your burden to 46. Yeah, me, I'm being practical. They reduce your burden to 46, right? So whatever theoretical marks that you spot in the exam, they should be able to look at what is the end picture. Eh? Someone told me that the goal is 50. The goal is 50. So anything above 50 is a bonus. So you need to plan like that. Because if you lose such 4 marks, chances of you getting those 4 marks on a computational bit, you need to be very good. Because what if you skip a step, right? Everything changes. So that theoretical bit is very, very, very important for us to be able to have. Then there's a question that can also be posed about accounting concepts. Can we mention a few of them? Some of the accounting concepts? Yes, sir. Duality, okay. Okay, let's, yes. Matching concept, okay.
Prudency.
Prudence concept, yes.
Going concern.
Accrual, going concern, yes. Historical costs, all those things. What else? Substance over form, money measurement concept, business entity concept. Basically, those are what we call the accounting concepts. Now, one thing that we need to know about the accounting concept is they may ask you again theoretical questions. For example, explain the application or the applicability of the accounting concepts. Are you getting it? Now, when they ask you to explain the applicability of the accounting concepts, please first explain what the concept means. Are we together? For example, when they say, explain the applicability of the going concern concept, you need to be able to state first what the going concern assumption means. Okay? So that is one way they can phrase that question. Another way they can phrase they may let's say give you let's say 8 accounting concepts, and they tell you to choose 5. Okay? And they tell you explain the accounting concept and its applicability, 4 marks each. So you should be able to really smile with such a question, because they're giving you the concepts. All you just need to do is explain what they mean and the application. I hope we know the applicabilities of those different concepts. Okay? But one thing that I just have to remind us is that when we are defining the accounting concepts, please let us stick to the definitions as laid out by the conceptual framework and the ISB. So don't just paraphrase the way you think or the way you understand them. For example, people tend to say the going concern concept that the entity will continue to operate in the near future. That's how people may say it. That is paraphrasing. Okay? So please, I believe right now you have your notes, you have your literature. Read them as you prepare. Any questions at that point? Are we good to go? Okay. Any questions?
Excuse me, Mr. Herman. Mr. Herman, excuse me.
Yes, Mr. Sarugo, please continue.
There's nothing I'm seeing, my dear, help me.
There's nothing that you are?
I'm seeing.
There's nothing that you're seeing because I'm not displaying anything. We are just discussing.
Okay. All right, all
we're
right.
discussing. That's why I wanted us to, unless you want to see a white screen, I can display it, but we are, at this moment, we're just discussing, right?
It is okay, sir.
Okay, all right. Now, there is something called accounting equation. Have you heard of it? Are we comfortable with the accounting equation? If they gave us, let's say, 3 transactions and they tell you to recognize them according to the accounting equation. Ladies and gentlemen, when I mean or when I refer to the accounting equation, I am meaning something like this. Let me just get there. Because I may be talking about some of these things and people may be not sure what we're talking about. So, okay, so you can see my screen. So when I mean the accounting equation, the accounting equation, we are referring to assets being equal to liabilities plus the owner's equity. So this is what I mean by the accounting equation. And this accounting equation is very simple. And it basically helps you also to understand how the statement of financial position works. Because when you look at the accounting equation, in simple terms, they are basically asking you for the statement of financial position, because that is it. Okay? Please, when you look at, actually, let me use this also, this, when I was explaining the accounting equation, let me also hint on the elements of financial statements. We talked about them, elements of financial statements. Now, these elements of financial statements that we have discussed, we have the assets, the liabilities, we have, of course, equity, we have incomes, and then we have expenses. Now, these 3 items go in our statement of financial position. Okay? Elements of financial position. And then these ones go in the statement of profit or loss. Now, I am deliberately using this to make it simpler for us. Why? As I'm explaining the accounting equation above, please note that when you're preparing either of those statements, you need to be mindful about which data that you are bringing, about which data you're posting to each of those statements. And that now would lead me to us, we need to understand how does the statement of profit or loss flow from the revenue to the net profit or the net loss. Are we together? The same applies to the statement of financial position, the assets and the equity and other liabilities. Candidates who don't know how those two statements flow may take an income item to the statement of financial position. By doing that, you're already losing marks. Are we together? So we really need to know. These 5 are the elements of financial statements, but we need to know where does each go to. So the accounting equation above, in simplicity or in simple perspective, is the statement of financial position in simple perspective. So we need to know that accounting equation. Now, as you know, the statement of profit or loss has, okay, we shall discuss it ahead. So that is, I wanted to mention the accounting equation, so they can give you some transactions to recognize it in the accounting equation perspective, but you just know that always assets have to be equaling to the liabilities and the owner's equity. Now, there is something very, very important, and he mentioned the duality concept. The duality concept is one of those concepts where, unfortunately, most of us as candidates get problems. Most of us get problems because of the duality concept. And the duality concept explains the principle of double entry. Now, that is where our biggest challenge in this paper. That's where if you look at those of you who read the examiner's comments, most of the examiner's comments when results have been released, and they upload these examiner's comments into your accounts, you will not miss an examiner mentioning a point of double entry. So when we talk about the double entry principle, we are basically simply saying that each transaction, okay, each transaction is supposed to be recorded twice. Okay? Each transaction is supposed to be recorded twice. In other words, if at all they say, bought a car, 50 million shillings, just simplicity as that is, it means that for every transaction, it has a two effect, right? It has to affect to at least two accounts. That's what we mean by the double entry principle. So what does that therefore mean? It means that for us to really understand this duality concept or the double entry principle, we need to again ask ourselves, what are the elements of financial statements? Because that's where they also come from. For example, when I say bought a car at 50 million shillings using cash, yeah? Which elements of financial statements am I hinting on? Bought a car at 50 million shillings using cash. Which elements of financial statements am I hinting on? Pardon? I'm hinting on the assets. You see that? Now, one asset is increasing, one asset is reducing. Are we getting that? So you need to know, how does that transaction feed into the elements of financial statements? Because at the end of the day, as you are posting your transaction, one asset will increase, one asset will reduce, one asset like that. So therefore, you need to analyze. So in simple terms, assets, expenses, yeah, assets, expenses, purchases, all these things have a normal debit balance. Okay? They have a normal debit balance. When they're increasing, you debit still. Okay? When they are decreasing, you credit. What am I trying to mean? For example, if I have a car and I buy another car, right? My assets are increasing. So I have to debit. I buy another car, I debit. I buy another car, I debit. The assets portfolio is increasing. But should I consider to sell off one car, it means my assets are going to reduce. So you need to know, how do I move? And when it now comes, let's say, to opening up a T account, let's say the assets account. Assets normally have a normal opening balance on the debit side, okay? And they have a normal closing balance on the credit side. So you need to know, how do I increase? How do I reduce? But everything is coming from the elements of financial statements. Do you understand them? Do you have an asset? Do you have a liability? Guys online, please let's mute so that we don't create a bit of noise for other members. Unless you have a question, you can unmute, and then you ask your question, and then we take back to the mute section. Okay, now, then we have our incomes, we have our equity, we have our liabilities. Then, of course, this is where we also have the sales and the revenue. Now, these ones have a normal credit balance, okay? Normal credit balance. When they're increasing, you credit still, okay? When they're decreasing, you debit. So, again, when we are comparing to the T account, if this is the liabilities account, liabilities have a normal opening balance that is for the credit, and then the closing balance is always on the debit side. What do I mean by liabilities increasing and credit? For example, if I told you you purchased goods on credit, yeah, you are creating a liability because you've not paid, right? You have a supplier that you've not paid. So that supplier, should you go back and take more goods, your obligation is what? Is increasing. That's why you're saying liability is increased by crediting. So you need to know that transaction that they're giving you, especially where you have, let's say, transactions where they ask you to prepare a cash book, for example. Questions about a cash book, you may find, especially if it's a 2-column or a 3-column cash book. One transaction before may affect the subsequent question, right? So you need to be well alert on how those transactions affect the other. Any questions? Any questions? Okay. We have discussed the source documents. Please let's know what source documents are: an invoice, a receipt, a voucher, and so on and so forth. Can we brainstorm, or can we discuss the accounting equation from start to finish? Stage 1, the accounting cycle. Stage 1, currency of the transactions, yes. Stage 2, journalizing, that is books of prime entry, okay? Are you getting that? Now, stage 1 of your accounting cycle is occurrence and documentation of accounting transactions. Now, where do you document those transactions? You document them in the source documents that we have discussed, right? Now, those source documents like the invoice, the purchase order, and blah, blah, blah. After that, you need to transfer that information into your journals. That's where you have these things of sales day book. For example, when you come fast forward, when you're doing, let's say, correction of errors and suspicious accounts that many of us enjoy, they may ask you, or they may tell you, the sales day book was understated. The sales day book was understated. Now, when you look at that question, for you to pass that transaction, you need to know what a sales day book is, right? Because if you don't know what a sales day book is or what it records, you will struggle with that transaction. Okay, so the books of primary entry, we have the sales day book, the purchase day book, the sales returns. Yeah, we have the sales day book, the purchases day book, the sales returns day book, the purchases day returns day book. Yeah, you have the cash book. Yeah, at etc. So now, when you look at the sales day book, it looks at credit sales. Now, should you now go to your topic of correction of errors and suspicious account, when they say the sales day book was understated, once you know that the sales day book is recording credit sales, you need to think about what? Receivables. Are you seeing how now is a simple perspective of a sales day book can connect to correction of errors and suspicious account, but everything is coming from the source documents and the books of original entry, the journals. So let's not look at these earlier chapters as if they are boring and you focus on the computation part, because the other side you know what to do, but something small might change your perspective on how you look at it. So we need to know how do we marry the suspense account and ABCD. So this is the journal. So a ledger, we know what a ledger is. A ledger has a credit and a debit side. I believe at this level, everyone knows how to balance a ledger. Okay, but those of us who might have forgotten, we know here you put the account. This is the credit side, this is the debit side. So you'll have entries here, entries here, entries there. Now, in essence, these two sides should be equal to the same figure. But there are some perspectives whereby one side is heavier than the other. So we use the weaker side, so the heavier side to balance off the weaker side. So should be able to know how to prepare the ledger. So that is your stage 3 of your accounting cycle, right? After occurring and documentation, you do the journals, you do the ledgers. Now step 4 is the trial balance. The trial balance. Now, why I talked about the ledgers is that they may give you a ledger, or they may give us a question that has about, let's say, 30 transactions, for example, 30 transactions. And then they tell you to extract a trial balance. They tell you to extract a trial balance. Now, when they tell you to extract a trial balance, the expectation is first prepare the different ledgers. They can be 20, they can be 30, and then you come up with your trial balance. Okay? Your trial balance will have the particulars, it will have the debit, it will have the credit. Now, your trial balance has to be self-balancing. Now, the trial balance is just a summary of the ledgers. You may have, let's say, 20 ledgers. All you need to do is to summarize them. Okay? Stage 5 is end of year adjustments. End of year adjustments are one of our challenges as candidates, because what I mean by end of year adjustments is when they give you a question and they say additional information. Okay, those are some of the end of year adjustments that I am trying to mean. Now, many of us struggle with if, let's say, they brought a question and they say prepare journal entries for the additional information 1 to 7, for example. Have we seen such questions? Now, basically what they're asking you in that question is which concept? Which concept do you think they're asking you when they ask you to prepare journal entries? Which accounting concept is that?
Double entry.
They're
Double
asking you
entry.
for the duality concept. Double entry. Simple. They're asking you, or simply telling you that these transactions 1 to 7 help us to have a debit and the corresponding credit. Simple. They're simply telling you, help us to give us a debit, give us a credit. Simple as that. Now, that is where, or this is where I told you the other perspective of we need to know what the double entry aspects look at. You need to know what are you debiting, what are you crediting? What are you debiting, what are you crediting? Okay? Because if we don't know what we are debiting, what we are crediting, it may become very difficult for us to really support ourselves or save ourselves. So, basically, when you talk about end of year adjustments, we are looking at, or we are simply looking at those aspects that may provide additional information to the already existing data in the trial balance. For example, they may give us a trial balance that has details, debit, and the credit. And then maybe here we have 100,000, even here 100,000. So the trial balance has balanced. But they go ahead to say, after this, we have some additional information. Additional information. Now, this additional information covers several perspectives. One, it may cover some expenses or incomes that are under the accrual perspective, under prepayments. Okay. 3, bad debts. Okay. 4, provision for bad debts. 5, depreciation. 6, closing inventory, etc. Now, these are some of the categorization that where our end of year adjustments may come from. Okay. Now, we are going to hit on one by one. Now, when we talk about accruals, we are looking at the accrual concept. Okay. What does the accrual concept state? What does the accrual concept state? What does the accrual concept state? Someone to volunteer for. Yes, sir. You're trying. By now, you should know. Yes.
You record
Okay.
record revenue when and expenses when incurred.
Okay, you're both right. So those of us who may not have had them, they are saying that transactions need to be recognized when they have occurred and not when money has exchanged hands. Okay, transactions need to be recorded as and when they have occurred, not when money has exchanged hands. For example, he used the example of incomes and expenses. For example, for incomes, you need to recognize incomes when you earn them, not when you receive the money. Earning is different from the receiving, right? For example, let's give an example of a salary. When you work for a month or you offer a service, you expected that at the end of the month, you expected to be paid, right? Now, when the month ends, let's say 31st of December, you have earned that salary, but payment may come either first or second or third, not so. Now, the payment date is different from the transactional date. The same applies to the expenses. When you acquire a car, on credit. Nowadays, cars are even acquired on credit, right? Yes, you acquire a car on credit. Do you have to wait to finish paying the whole total cost of the car before you get the car? No. So you recognize for you have received the what? The car. Now that's what accrual concept is basically talking about. So under accruals, we may have what we call accrued expenses and then accrued incomes. Now, these ones are current liabilities. Then these ones are current assets. Now, let's discuss what each of those two means. Now, when we talk about accrued expenses, we are simply looking at those expenses that you have incurred. In realistic perspective, you have not paid for them. Okay? For example, if I told you, yes, you rent a house and you sleep in the month of October and you don't pay the rent, let's say 1 million shillings. And then you also sleep in the house in November currently. How much would your landlord be demanding you if you're supposed to pay rent of 1 million per month? 2 million, right? 2 million. The 1 million is the expense for the month, right? But you have a liability that you did not what? Pay for October. So that 1 million that they may give you in the additional information, for example, yeah, that 1 million, you are going to recognize two things. You're going to recognize that 1 million in the additional information, what? Twice. Remember what we said, duality concept, right? How? One perspective, you're going to record that transaction in the profit or loss, right? And then the other perspective in the statement of financial position. Let's give an example as we also hint on the generalizing. For example, they say that you have rent in the profit or loss as 1 million shillings. Okay, let me say 4 million shillings in your statement of profit or loss. And then they say additional information, rent due for the period is 500,000. Rent due for the period is 500,000. Now, and then they ask you to prepare journal entries for the additional information. You see that? Now, that 500,000 and the 4 million are both rents, right? Now, this, of course, when you're preparing your statement of profit or loss, you'll post it to the profit or loss, right? So that's why expenses go to. But now we have a problem here of this 500. How are we going to treat it? Now, remember what we said. We need to have a debit. We need to have a credit. So the double entry to record an accrued expense. The double entry to record an accrued expense. Remember what we said, that we need to recognize that the entry is having both debit and credit. So the double entry to record any accrued expense is you're going to debit that expense and then you credit the accrued expense. You're going to debit, or in other words, if I don't to confuse you, let me just say the payable account, the account that you should have paid. Okay, the account that you should have paid. That's what I call the payable account. For example, now here we have rent. that is due, that is 500. So our double entry, we are going to say rent expense, which is 500, and then we say accrued rent or rent due, also 500. Are you seeing one transaction being captured twice? Here is the fact. This debit here is going to go to the profit or loss. And then the credit is going to go to the statement of financial position under liabilities. Remember what we said? That liabilities have a normal credit balance. Are we linking the two? Any questions? Okay. Now, this is what we mean by accrued expenses. Now, why are we taking this entry here to the statement of financial position? We said that 500,000 has not yet been paid, right? It is outstanding, it is due, it is accrued. So you should be able to know that that entry is supposed to go to our statement of financial position. Now, if this is our accrued expense, and we say that accrued expenses are liabilities, you just flip for accrued incomes. Accrued incomes are those incomes that you receive when you've not earned them. Okay? In other words, the person who is paying them, to that person who is paying, that will be their asset. To you who is receiving, it will be what? A liability. So it's just the reverse. Are we together? For example, let me use again the example of a salary, or even rent that I used. When you're entering a house, you pay 6 months, right? When you pay 6 months, each month is 1 million. Your landlord is going to receive 6 million at once, right? When your landlord receives 6 million, but you're not going to sleep in the you're not going to sleep in the house the 6 months at once. You have to sleep month per month. So it means that when you pay 6 million at the start of January, your landlord is receiving extra 5 months of rental income that he has not yet earned. Are you getting? So to your landlord, the extra 5 million, it will be a liability. To you who has paid, it will be an asset because you will not pay in the subsequent 5 months. I hope you are together. Any questions? Is it well understood? Online members, we have some questions. Please notify if you can't hear me, and I'll be able to adjust my network if it's not good. Okay, we proceed and look at the prepayments. Now, the prepayments, just like we have used the example of rent. Also, the prepayments, we have two. We have the prepaid expenses, and then we have the prepaid incomes. Now, this is just the reverse, okay? Prepaid expenses are current assets. Prepaid incomes are current liabilities. Now, this is just the reverse, okay? So, if you're to look at prepaid expenses, when you pay your rent expense, again, the 6 million at once, the extra 5 million will be, you would have paid for rent, okay? But you will not pay in the other 5 subsequent months, okay? So that will be an asset to you. And then to the person who has received, it will be a prepaid income. Prepaid income is sometimes called income in advance. Income in advance. In other words, the person has received income which they have not yet earned. Okay, I hope we are together. Okay. We go to bad debts. What is a bad debt? What is a bad debt? And how does a bad debt arise? What is a bad debt? Yes?
Arises by selling on credit.
It arises as a result of selling on credit. And then she's saying that a bad debt is a debt that cannot be recovered. Okay? Are we in agreement with them? Yeah? Okay. Now, when you sell on credit to a customer, of course, a customer will come and say you sell to them on credit. Now, when you sell to a customer on credit, that customer may promise you to pay, but they may not pay. So when they don't pay, you remind them of their payment, you follow up, but you take all the necessary steps to recover the money, right? But they fail to pay. And then you decide to get annoyed and angry and say, let me write this debt off. This person is not going to pay back. Now, that debt has to be recognized in your books of accounts, in your statement of profit or loss as an expense, because you've lost, right? Now, the double entry to recognize a bad debt or a bad debt written off is to debit the bad debt and to credit your trade receivables. Why do we credit trade receivables? Why? Because these guys were our credit what? Customers. They were your credit customers where you expect to receive money from. Please, I am deliberate on the debit and the credit because of the duality concept. So you need to be in every step you're thinking about. You need to be looking at your duality concept. Now, that bad debt has to be captured. This one will go to your profit or loss, and then this one will go to your statement of financial position as a deduction on your receivables. Now, this is the simplistic thing. Now, it's a complicated thing, but a more technical thing they normally ask you is for you to explain the steps that you take when a bad debt customer after some time appears and say, I want to pay your money. Okay? You had previously written them off and you posted this transaction, right? Now, after 2 years, they come and say, here is your money. How do you recognize that money in your books of accounts? Yes, sir. It is recognized as other. So we were still saying that the entries that we're going to pass to recognize that data that you had previously written off is, we are going to debit what? We are going to debit She says we are going to debit bad debts and credit incomes. We agree? Yes, you shook your head. Which entries do we pass? Now, that's those of you who have not heard her. When you have a data that you had previously written off in your books, when they resurface, you first bring back that data in your books. Are we getting that? So, the first stage to recognizing the income that the person is going to bring in, you're going to first reinstate the data. Now, they can ask you for just 3 marks, the accounting for recognizing a bad debt that has been previously written off. So reinstate the data in the books of accounts. By doing what? By saying you're going to debit your trade receivables, and then you credit bad debt written off. That is your first stage. The second stage, on receiving the money, receiving or payment, you're going to debit your cash or bank, because now the person is giving money, right? And then you're going to credit the trade receivable. Now, here again, you're removing the data from your books because you have reinstated them again, right? But now when they pay, you remove them again. Now, stage 3 is to transfer. You're going to transfer now this item, transfer the transaction to the statement of profit or loss. Or you're going to transfer the debt, transfer the debt recovered in the profit or loss. By doing what? By debiting what? By debiting your bad debts recovered or bad debts written off, and then you're going to credit what? Your profit or loss. Now this is where the other gentleman was saying other income. So this transaction is going to be recorded under other incomes. Those are the 3 stages. Or if they ask you, explain the accounting treatment for bad debts written off, as those are the 3 steps. Now, when they give you one transaction like this in your additional information, right? You don't have time to go through all these things. You don't have time to go through all these things. Now, someone is asking a question online. So when they ask you, or when you have that one transaction that they have given in the additional information, right? You don't have to go through all these steps. All those steps can be summarized into one. Debit, credit. That is the bank or cash, and you go to profit or loss. But how do we come to this? How do we come to that? How do we come to that summary? Let me show you how we come to it. Look here. When you see the first stage, insert the data into the books of accounts, trade receivable, and credit bad debt written off. In the next stage, you're saying when you receive the money, you're going to debit cash or bank and credit trade receivables. This debit here will cancel with the receivables. So that this credit here is going to cancel with this debit here, leaving this account. There's this person who is this Herbert. I don't know if it's you, but kindly mute. Let's mute so that we have a bit of silence. So I was still saying that you have the first blue, trade receivables, cancelling with the credit of the receivables. Then you have the credit of bad debts, cancelling with the debit of bad debts, leaving you with the cash and with the profit or loss. Are we together? That is how we come to. Now, this is the transaction that you will pass in your journals. Are we together? Any question on bad debts? That is it on bad debts. Please, if you have any question on bad debts, do ask. So are you? When you are doing the revaluation account, and they say, this is it. This is it. Now, he's asking, he's saying that when you're looking at the revaluation account, that is partnership now. But they have asked you about bad debts. The concept doesn't change. They're just picking one. That's why I told you, of your adjustments can feed in any other topic. Okay? The concept never changes. As long as you know the debit, please note debit and credit. This is it. Once you forget the duality concept, you're finished. And you'll see. You may not indirectly see it as you're practicing, maybe, but every transaction that you're going to be posting has an effect on the duality concept. So far, we can agree, right? So far, we can agree that we have tested it and seen. So nothing changes. Just know what is the principle. Now, at that point, when you're looking at partnership, for example, they may not ask you to prepare the bad account, but in your mind, you're implying it that it's there. So post the credit if need be, or post the debit if need be. Because in partnership, you don't need to waste time. Partnership is a bit wide. So just do what they have told you. We shall anyway come to it as we progress. So that is bad debts. Let's go to another one, depreciation. Do we have any issues on depreciation? We do. Okay. Not dispose of assets, I hope. Okay. I'll look at them. Now, before I go to depreciation, there's provision for bad debts. Now, the difference with provision for bad debts and bad debts is that bad debts, you have already written off. For the provision for bad debts, you have not yet written them off. You're just simply anticipating that there's a likelihood that this person may not pay. So you also have to provide off of your trade receivable. That's why you'll see questions coming. Let's say provision for bad debts are supposed to be provided for at 2%. So just get the 2% multiplied with your trade receivables. And then when you come into the statement of financial position, you subtract them off your receivables. Okay? Let me go to this session now. In your end of year adjustments, I'm still at end of year adjustments. If you've been noticing, I'm discussing the accounting cycle, right? I'm at end of year adjustments now. So on the depreciation, straight line method, straight line, then reducing balance method. Now, in your reducing balance method or straight line method, straight line, they may say, actually, straight line depreciation is charged at cost. In other words, charge the depreciation. Someone is saying, I still have a problem understanding pro rata and time apportionments. Salome, that's where I am heading. Just listen in. Just listen in. You should be able to be okay. Now, there are some people who are speaking. I don't know if they're asking questions or you are looking at something else, please feel free to, let's speak through the right channels. Let us speak. If you have a question, please do ask. I'll be comfortable to give you the floor. But in the meantime, let's try to maintain decorum. So, straight line, under straight line, they may not tell you that depreciation is charged on straight line. Okay? They may just say, charge 25% at cost. Just at cost. So you need to know that at cost, they're meaning straight line. Now, whenever a question has depreciation, please be mindful of the following. One, look at the end year of the firm, the end year of the company. In other words, when does the financial year end? Okay. Two, the acquisition date. The acquisition. When was that asset what? Acquired. Okay. Now, when we go to straight line, under straight line, they may, two things, depending on the information that you're given. But the first thing, or the first way how we compute depreciation using straight line, we say cost minus the scrap value divided by the life of the asset. Okay? Now, this scrap value can also be called the residue value, can also be called the salvage value. So depending on what the examiner has given us, can be either comment about the discounts. Someone is saying that I should comment about discounts on provision for bad debts. I think, okay, now, okay, let me just hint on that. Now, on the discounts, one thing you need to know, what are the two types of discounts? Okay, you can give a trade discount and a cash discount. Okay, a trade discount is given when a person does what? Buys in bulk. A cash discount is given when a person is going to pay promptly. So they can again ask you, distinguish between a cash discount and a discount, 2 marks. So now the cash discount has discount allowed and discount received. Now, when you are the person doing the question, you need to know which side are you. Okay? When you are the person attempting the exam or the question, you become that question, right? For example, if I told you if I told it is ABC Limited, you become ABC Limited. Now, a cash discount, when we have discount allowed, it is now the business offering the discount. So in other words, if I told that business was supposed to receive 10 million and it gives 2% discount, that means it's going to receive less of the 10 million. So that difference is going to be captured as an expense in the statement of profit or loss. If ABC Limited is the one receiving a discount from the supplier, that's going to be a discount received. In other words, if you are supposed to pay 10 million, but the person offers you a discount of 2%, that means that extra equivalent of 2% which you should have paid is a saving. Okay? So it becomes a discount received. So that is going to be captured under your other incomes. Now, what happens is you need to know where do you recognize them and who are you in the first place. So if you are the business, you need to look at it from that perspective. Are you receiving it or are you giving it? Are you together? Yes. Yes. Mm. Okay, so she's asking, if at all they give you, let's say, receivables of 10,000, and they say the entity received 8,000 after allowing a discount of 2%. Yeah, right? They are already given you the figure. Okay? The entity received 8,000. Now that is the cash they received. Meaning your receivables that were initially 10,000, the customer paid you 8. That's what you received. So two things. We expect your receivables balance to reduce, right? Two, we expect your assets in forms of cash or bank to increase. But then we expect you to recognize the receivable. So the expense, which in that case is discount allowed. Now, in that case, it's going to be the 2,000. Because they have already given you your opening receivable balance. They have also given you how much you collected. So the difference is the discount. Yes. Mm. Mm. Yes. That's why I'm saying, if at all they give you the opening balance of receivables, and then they give you how much collected, you cannot start computing percentage. You have to get the difference between how much the opening and the, because you just look at it here. When you draw a T account, receivables, right? Opening balance, 10,000. Balance carried down at that moment will be how much? A certain figure maybe, right? Then your cash will be here. Receivables control accounts. You see that? We are coming to control accounts. So it means that because they have not given you this figure here, using your example, yeah, the difference of 2,000 is going to be the discount. And as you know, we have discount allowed this side as an expense, right? To do the double entry of discount allowed as a T account, it will be on the debit side. Now, in that instance, you're saying that you cannot compute. Why? Because you have a limitation on facts. You have a limitation on the amounts. And then the other thing is the discount cannot be more than the receivables balance, right? Because you're offering a discount so that you can collect money from these people before they become what? Bad debtors. Are we getting it? So there's no way that the discount you're offering is more than the balance that you had. For example, I can say I have 10 customers who are bad debtors, but the discount that I'm offering is 12, or it's rating to 12 customers. That is not possible, right? Because the discount has to fit in within the debtors, right? Yes. Hmm. This one. Let's put the figures there. Assuming the opening balance of the receivables is 900,000, okay? Mm. 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 You can't do 2% of 500 because the 500 is how much you're actually receiving. You do 2% of the 900 because the 900 is the amount you expect or you expected to collect, because all those equivalent of 900 customers took goods on credit, but you're offering them a discount so that you can recognize cash faster. Yeah, so there's no way you can do on the 500 because the 500 is what you're actually receiving. Yeah. We're together. Okay, we were on straight line. So I was saying that one straight line, they can give you information, giving you the cost, the scrap value, and the life. That is one way. The second way, how we compute depreciation on a straight line, is by getting the rate of depreciation times the cost. So depending on the information given in the exam, you can use either two methods. That is straight line, as simple as that. Now, we go to reducing balance method. Now, the reducing balance method, reducing balance, for it, depreciation is charged on the net book value of the asset, the net book value of the asset. But the net book value got by getting the cost minus accumulated depreciation. So before you, now, the depreciation for it now, the depreciation will be equaling to the rate times the net book value. The rate, of course, is in percentages. So before you get to this point here, you have to first use that. Now, questions on depreciation. Which question was that? I'll get there to that topic, but let me just use this example to just bring out what I want to mention. Do we, by any chance, have our past papers? Do we, by any chance, have question banks? Okay. I just want to just hint on something small, and what? And you'll see how reducing balance method comes about. Okay. Reduce. Okay, I just want to just hint on something small. We were not going to do the question. I'm just hinting on something small. Let's go to okay. So I would like to draw our attention to this question of May 20. Was it? Okay, I think it should be May 2024. Yes, it should be May 2024. Let's just check May 2024. Have we seen it? We are just going to illustrate. We are going to illustrate reducing balance methods. I don't know if that part is there. I just want to illustrate something. Okay. Okay, so I think, okay, so let's just look at it. So May 2024, there is a question that was asking us to use reducing balance method. Yes, I believe. So let's go to question number. Is it reducing balance? No. That's not the one. Not the one. That one had cost. Okay, sorry about that. Let me just try to look for any that can help us to illustrate it. I just want to pick any. As long as it brings out the explanation, should be good to go. Okay, look at May 2025. Yes. May 2025, question number 2. May 2025, question number 2. Okay, May 2025, question number 2. Now, when you look at that question, it was about partnership. But I just want to illustrate additional information, Roman numeral 2. See the question? Please don't. But now, if you look at me, what will happen? You will not understand what I'm talking about. You've seen it, eh? May 2025, question number 2. I want to draw our attention to Roman numeral 2. Okay? Roman numeral 2. Are we there? Please confirm so that we can illustrate it very quickly. May 2025, question number 2.
We are there.
May 2025, question number 2. Okay, you're there. Now, look at share the question. My friend, at this point in time, you need to know where to get the questions from. You can download this question as simple as 1 minute from the palm of your hands. Okay? By the time I start sharing, it's going to take me a long time. Anyway, let me just bring out the facts to save time. Okay? Let me just bring out the facts. So when you see in that question, you have motor vehicle. Okay? You have motor vehicles, actually, not one motor vehicle. You have motor vehicles at cost with the cost of 65 million. Okay? Then they are giving you some depreciation on 1st January 2024. The depreciation they are giving you has several other assets, but I'm more interested in the motor vehicles. Okay? Motor vehicles had it has depreciation of 16,250. Okay? Then when you go to additional information number 1, Roman numeral 2, they say the depreciation for the year ended 31st December 2024 had not been recorded. LTC provides for annual depreciation as follows. Motor vehicle was 25% reducing balance. Now, this is what I wanted to illustrate. Now, Here, they have given you a certain depreciation here. They have also given you the cost. Okay, so this one is very easy. We will just get the 65 million minus the 1625, because that is the depreciation of prior years. Okay, because they are motor vehicles, meaning that by the time they give us this data, those assets had lost in value to the equivalent of 16.2. So now this part here, from here to here, that's what we mean by the net book value. Okay, so it is this that we shall multiply with our 25% to get that depreciation that you recognize in your statement of profit or loss. Are we together? Let me assume that this answer here is 2 million shillings. Okay, so in your statement of profit or loss, you're going to recognize 2 million. In your statement of financial position, when you're doing your assets, right, you'll say the cost, which is 65 for the motor vehicles, minus 16 minus 2. In other words, in your statement of financial position, your accumulated depreciation is going to be the 16 plus the 2 million. Are we together? That is end of year adjustments. The lady who talked about apportionment, I'm coming. We shall handle disposal. Unless you want me to handle it at this point. I proceed that I go straight to disposal, or I first finish the accounting cycle. Yes. Yes. Okay, that's what I was coming to. Now, there's a question here. If they tell us we use reducing balance method, but they did not give us, assuming we were given an opening and closing depreciation, and again, let me just pick that question as well as I come to your question. Please use the comment section to post your questions. Assuming you are given opening and closing depreciation, and against motor vehicle, they put costs in brackets. How do you adjust that? I didn't get your question. Maybe if you can rephrase it, I'll be happy to respond to it. So, in the meantime, let me be responding to, in case I'm not given this 10 million, but they tell me to use reducing balance method. Are we getting that? I was not given that 16, but then they tell me to use reducing balance. So it means that in year one, I will apply straight line. Okay? In year one, for that asset, I will apply straight line. Let's say I am going to get 5 million. Now, it is in year two that I will apply the reducing balance. I will have my 65 minus the 5, multiply with the 25. We are together? Yes. Please, you can rephrase your question again. I'll be happy to respond to your question on, yes, sir. Okay. In case we were using reducing balance method and they tell you the asset was revalued, which cost do we take? What do you think? How would you handle that question if it came on the 8th of December? You might use the new cost. Why do you think you will use the new cost? Now, those questions that I'm posing right now are questions you're going to have. Unfortunately, you're going to be asking them yourself on that day. Now, if an asset is revalued, and you're right, you're going to use the new cost. Where do you get that concept? You get that concept when you're looking at International Accounting Standard 16, PPE, that looks at assets. That standard says that assets are recognized at cost. Or Yes, initially at cost. Now, that is conceptual framework, you see? Subsequently, that standard says the assets are recognized using two perspectives, what we call the cost model and the revaluation model or the fair value model. The cost model is what we know, cost minus accumulated depreciation. The revaluation model or the fair value model says that assets should be recognized at the revalued amount. So that is why you think you would use the new cost. So in that perspective, you would leave the old cost for a new cost. However, something has to come into your perspective also. Should they tell you that these assets were revalued? The question you should ask yourself, were they revalued upwards or downwards? If they were revalued upwards from 100 million to 120, what does that mean? You have a revaluation gain. If they are revalued from 100 to 80, you have a revaluation loss. Where would we recognize the gain and the loss? Think about that as you prepare to read, okay? Because they might give you a gain or a loss. First for us, not just even exam perspective, even real practice, okay? So think about as you read. Any question? Okay, so that is end of year adjustment. Now, the last stage of your accounting cycle at this level is to prepare your financial statements. Okay, you prepare your financial statements. Your financial statements are going to be prepared using those different concepts. Okay, those different concepts. As we have said, that the statement of profit or loss only has incomes and expenditures. Please do not put assets in your statement of profit or loss. Do not put equity in your statement of profit or loss. In your statement of financial position, have the assets, liabilities, and equity. In your statement of changes in equity, you only put equity parts, only equity. At this level, we don't have cash flow statements. So you need to know how do your financial statements move. Assets like that, eh? That one I will not go through them. Now, allow me to go to how do we dispose of assets, or we should take a break and then we come back when we are fresh. We continue, or we take a break for 5? Okay, let's take a break of 5 minutes. Online guys, let's take a break of 5 minutes. We stretch, come back. Please, we have a lot of cover. So, yes,
Mr. Herman,
go. Yes,
I need
go.
your help with changes in equity. To me, it is a very big problem. It's like if it is
You need
possible,
my
can
help.
I
Even now, I am revising. Yeah? Okay. Joseph, I think you okay. We shall discuss, Joseph. Eh? We shall
I will
discuss.
require my to me to get a question out of that number, then we do changes in equity.
Okay. Okay. Let me see what we can do. Let me see what we can do.
Thank you so much.
So let's take that break and then we'll return shortly. Okay, I think we should proceed. Serugo, I will see at the end. I'll present a request at the end. Let me just proceed as I had planned. I'll look at the changes in Equity at the end. Okay, so we go and look at disposal of assets. Disposal of assets. Now, when you look at the disposal of assets, you need to be mindful that, or you need to understand the concept of revenue, expenditure, and capital expenditure. Okay. Now, revenue expenditure relates to that expenditure that is incurred in the maintenance of an asset, and then the capital expenditure looks at that expenditure that is incurred in the acquisition of the what? Of the asset. Now, one thing we need to know is that revenue expenditure is supposed to be expensed, and then capital expenditure is supposed to be capitalized. So they may give you an asset. Let's say the asset was acquired at a purchase price of 50 million shillings. And then they give you several other costs. For example, the cost of transporting the asset from, let's say, Mombasa to Kampala, maybe the cost of insurance, the cost of installation costs, among others. So now you need to know what is the capital expenditure and what is the revenue expenditure. That is the first part. Then the second, in that part, basically what I'm trying to refer to, you need to know what are the elements. What are the elements of cost? What are the elements that form the cost of an asset? The cost is not just the purchase price. There are several other elements that are involved in the acquisition of asset. Now, after that, you need to know how or which steps are involved when an asset is disposed. In other words, what accounting steps do I need to take or do I need to follow when an asset has been disposed of? Okay, that is the first or the second thing. So there are 4 steps or there are 4 stages where all that are involved when an asset is being disposed. So, disposal of an asset. So the first step is to transfer the cost of the asset from the assets account to the disposal account by debiting disposal account and crediting the non-current assets account. But all this should be done with the cost of the asset. In other words, you remember what we talked about the other side where assets increase by debiting and then by crediting. You have to remove that asset from the assets account to the disposal account. Stage 2 is to transfer the accumulated depreciation. Transfer the accumulated depreciation of assets disposed of. In other words, you're going to transfer the accumulated depreciation that that asset that you're disposing has accumulated over time, okay, from the accumulated depreciation account, pull. From the accumulated depreciation account, accumulated depreciation to the disposal account by debiting accumulated depreciation and then you credit what? The disposal account. Stage 3, these are the 4 steps that you need to go through when you're disposing. Stage 3 is to recognize the sale proceeds. In other words, what you are receiving when you're selling off the asset. Debit, cash, or bank, or receivable, because you might dispose of on credit. Disposal account. Stage 4 is to close off the disposal account. Close off the disposal account. Now, the disposal account does not have balance carried down, balance brought down. Do you close off in order to determine a gain or loss on disposal? Okay. So for the gain, we debit the disposal account and we credit what? Profit or loss. And this will be the incomes. For the loss, we debit the profit or loss, we credit the disposal account. So they can give you normally that question, they normally ask you to prepare 3 accounts. Okay, let me just go. So those of you who are writing something, this was stage 1. Okay, that was stage 1. Then this is stage 2. Then there is stage 3, and then stage 4 is here. So this question, they ask you to prepare 3 accounts normally. To prepare the assets account, to prepare the accumulated depreciation account, and then to prepare their disposal account. Now, the challenge with this question is 2 things. They minimum, you're going to prepare for 3 years. Okay? But then, rarely do they give you a question and you have to prepare for only 1 year. Sorry, 1 asset. So they are going to give you multiple assets. So you need to know, how do I go about this question? You need to know, how do I go about this question? You need to know that you're going to handle those assets, you're going to handle year per year, and at the same time, you are supposed to dispose of your assets very, very clearly. And okay, yes, sir. That's what I'm coming to. Okay. Now, in such a question, one thing you need to know is the examiner. So when you're looking at this question, look out for these comments. 1, depreciation is time apportioned. So when they say that depreciation is time apportioned, it means that when you're computing the depreciation of the asset, there are some assets whereby depreciation will not be for a full year. Okay, that's what time apportionment means. It means that, so, oh, sorry, let me just first finish them, and then they say it's the company's policy to ignore depreciation in the year of disposal. Then 3, we have the acquisition date. Then we have the end year, or the financial year. Financial year end. So when we are looking at such a question, we need to be mindful about this aspects. Now, when we say that depreciation is time apportioned, it means that that entity, when it's acquiring some of its assets, some assets may be acquired within the middle of the year. For example, if the year end is 31st December, for example, 31st of December, and they acquire some assets, let's say in October or in July, but then the rate of depreciation, the rate is supposed to be an annual rate. Okay? It means that when you are computing or when you're charging depreciation for that asset, you're not going to charge a whole year. So you're going to compute when was the asset acquired, when was the asset disposed. If the asset was acquired mid-year, chances are high you're going to use time apportionment, sir. Okay? You're going to use time apportionment. We shall see. Okay? As we are doing. Then the second thing, they will say it is the company's policy to ignore depreciation in the year of disposal. For example, if we acquired an asset in the year 2019 and they dispose of this asset in the year 2024, how many years are these? Ideally, they are 5 years. Okay? But when they say ignore depreciation in the year of disposal, it means that you're going to dispose 2019, 2020, 2021, 2022, 2023. 2024, you'll ignore the depreciation. So when you're doing such a question, please be mindful of such statements. Now, they may say that the asset or use time apportionment. Now, in the first year when you acquire the asset, you may use time apportionment. But in the second year, the asset may be supposed to be depreciated in full. So depending on the question, please look at the acquisition date, look at the end year is, and then look at disposal date. When was the asset disposed? Disposal. Because that disposal date is the one that's going to be key to guide you whether you should depreciate using time apportionment, or you should use what? Or you should use the other way around. Yes, sir. No. Please ask. You're not disturbing me. Yes. Asking which scenarios are there for us to get a gain or loss on disposal? This is very easy. You compare. Let me put it here. You're going to compare the net book value of the asset and the sale proceeds. In other words, the net book value, you know how to get it, right? Cost minus estimated depreciation. Let me use an example. I told I want to sell my phone. I acquired my phone at a certain time, and it has depreciated over time. There is how I am valuing it right now. That is my net book value, right? But when I go, let's say I'm valuing it at 1 million. When I go to sell it, I look for buyers and I get one prospective buyer who says, me, I'm willing to offer you at 1 million. That's my last price. So you negotiate until maybe you reach a consensus of 2 million. Now, I am valuing it at 3. She or he is giving me at 2 million, right? So in other words, my net book value is exceeding the sale proceeds. The question, have I sold that phone at a gain or at a loss? It's at a loss because I'm valuing it at 3 million, but I'm only receiving 2. So in other words, you're going to compare the sale proceeds and the net book value. Where your net book value exceeds your sale proceeds, the sale proceeds are what you are receiving. Proceeds are what you receive when you sell. Okay? When your net book value exceeds your sale proceeds, you're selling your what? Only you would have got a loss. The reverse is true for when the sale proceeds exceed the net book value. That's how you get a loss or gain. Okay. Yes, sir. I mentioned that. I mentioned it. You were outside. I mentioned it. I talked about insurance. I talked about installation. I talked about trial runs and commission. I talked about transportation. I talked about what else? I mentioned them. Where they also acquired. So I mentioned them. I think you are just not listening to me. I even talked about capital expenditure. Those are the assets. Those are the costs that you're going to capitalize. There's a question I tried where they also required a depreciation account. Yes. How different is it from the accumulated depreciation? How do you attempt that? Did they just want the calculation or no? There's a question where they ask you to prepare the depreciation account. Now, please don't get confused. What is the double entry to recognize depreciation? Debit depreciation expense, credit accumulated depreciation. So when you compute the depreciation, you're just going to post one transaction twice. So you're going to, the debit will be a depreciation expense. The credit is going to be accumulated depreciation. So it wasn't a mistake. So it is very, very okay. Okay. So that is very okay. I want to get a question where we can do time apportionment.
Excuse me, sir.
Yes, please.
I have a question. Assuming you have two assets, which is bought, one is bought in October, then one is bought on 31st of December, let's say 2024. Both were bought in 2024. One is bought in October, then one is bought in December 2024. And they have asked you to the depreciation. It is time apportioned. How are you going to calculate the depreciation expense for this? Will you also calculate the depreciation expense for this asset bought in 2024, 31st December, or you will start calculating it in 2025?
So when they say that depreciation is time apportioned and they give you these two assets, this one you're going to have 3/12, right? This one you're going to have 1/12. So you're going to depreciate from that month. We don't compute. That's why I was telling you that on depreciation, be very alert. We don't compute days. So we compute that month. The asset, we shall depreciate it from, even if it was acquired on 31st of December, we shall take it as 1 month. Okay? We shall not say, no, we are going to use it only, or we shall compute its depreciation next year. No, it will be that very, that very year. Okay? Can we have a question that anyone who has a question, scenario where they say the assets were revalued and they sold on the same day? I think I talked about revaluation. Vivian, I don't know if you were listening. Someone asked on revaluation and I discussed that already. The assets were revalued and then sold on the same day. Yes. Guys, don't get confused. The revalued amount becomes the new cost of the asset. That's what I think he asked that question. I talked about the revaluing upwards and downwards. Yeah, you recall. The revalued amount becomes the cost of the asset. Now you're going to be comparing that cost and sale proceeds. Basic concept. Which sitting can we do? I want to just bring out this concept of this disposal. I hope we can do it very quickly. Yes. If they don't ask for the bank account, don't prepare it. Don't say your own question. Please, I'm going to talk about the time. In maximum, you have 36 minutes per question. How are you going to prepare things I've not asked you? If they don't ask, you assume. That's why I say there's some things you'll assume. For example, if they say no bank account, for example, but then they tell you that the entity disposed of a car at 50 million, you assume debit is going to the bank, then the credit is going to dispose. Don't open the bank account because you've not been asked for it. You see, this time you're drawing a T account and you're feeding in data. 2 minutes are going. 3 minutes are going. If they ask for it, fine. If they don't, the same applies to partnerships. Are we together, sir? Okay. 20 what? 20 what? Oh, I proceed. You've got the logic. No, I don't proceed.
August 2025.
Yes, sir?
August 2025.
August 2020. Okay. Someone else saying 2023, 2022. Anyway, we will not do all of the questions, guys. The thing is, we just want to get the concept. Yeah? The issue is just getting the concept. You will try out. There are so many questions. There is December 2022. It has that part. Talked about he talked about 2020, December 2020. Okay. Okay. So someone is asking a question of May 2025. Let's just get there again shortly. Just let's go back to the question of May 2025. Someone has a question there. Let's just get back to May 2025. So May 2025, question number, May 2025, question number what? Question number 3, she's asking about note 3. Okay, I hope that is it, Vivian. 3. So she's saying that on 1st January 2024, OBM and IBM machines were revalued to their fair values at 45 and 40 million respectively. Their remaining useful lives were reassessed to 5 and 4 years respectively. Assume that OBM and IBM machines available at the time of revaluation were bought on the same day. Now, we need to ask ourselves, when were those assets acquired? Okay. Now, those assets were acquired. Those assets were acquired when? those assets were acquired. The OBM machines, yeah, the OBM machines were acquired at 120 million. Okay, the OBM machines were acquired at 120 million. So you need to look at the cost, which is 120 million. Okay, then I believe when you look at note one of the assets was disposed. So you have the OBM machines at 120, but then they're telling you one of them was disposed. So that one that was disposed initially had a cost of 20 million. Okay, so you're going to first remove that 20 from the 120. Okay, so that you have a new cost of the remaining OBM machines. Okay, because they said you had OBM machines, but then one of them is the one that is what? Being disposed. So the question is, how many, or what is the worth of the remaining machines? That is 100,000, right? Now, it is 100,000 that you're now going to start to depreciate for those years until when the revaluation took place. Okay? So it is after you have come up with the net book value of the asset at the time it was revalued, then you will compare the net book value and the valued what? Amount for you to know, is there a loss or a gain on revaluation? Is it okay now, Vivian? Because the assets that were valued were only those ones that remained, one who had been what? Disposed. So you cannot take it as valued. You have to first remove it first. Anyway, this is what I'm saying. So when you look at that question, you had OBM machines in plural, right? 120 million. But then you had one which had a cost of what? Of 20. It was removed. So you're going to remain with the remaining assets worth 100,000. Now, it is this 100,000 that you're going to start depreciating. I don't know how many years they were. You depreciate using the rate they gave. So, because I'm seeing that those assets were acquired in the year 2022. So it means that in the year 2022, you're going to have a depreciation. Okay? Then they're telling you that those assets under note 3, they were revalued in the year 2024. Okay? But then note 6 says ignore depreciation in the year of disposal. Right? So you're going to depreciate for year 2022, and then you depreciate for the year 2023. So here you'll have a figure. Here you'll have a figure. Then afterwards, you're going to have a net book value, right? And then you're going to have a revalued amount, which they're giving you as how much? We revalued it at note 3. The OBM machines, they are being revalued at what? At 45 million. Now, you're going to compare this figure with this for you to know whether you have a loss on revaluation, you have a gain on revaluation. Now, she was asking, what do we take? Do we take the revalued amount or the what? Or the net book value? You'll have to first establish how much was the revalued amount, how much was the net book value, and then you now come up with either you have a loss, gain on disposal, and that is what you're going to factor in your disposal account. So that is it. Yes. Yes. She's looking. If we deal in cars and one car is involved in an accident in the year 2021, but then we incur some expenditures to repair it before we dispose it off in 2023. How do you recognize that? That asset, as soon as it's involved in an accident, that is disposal. You now need to read what are the causes of disposal. Accident, even if they have not told you that this asset has been disposed of, once you see the asset was involved in an accident, that is disposal. Immediately, you're going to remove that asset from your cost, because you're not going to have it in your asset register again. Now, these are the costs that you incur to repair it before you sell it, is what I started with. Revenue, expenditure versus capital expenditure. Those costs of repair, you're going to consider them as expenditure. You will not capitalize them. No. When it comes to calculating that depreciation, you're going to compute the depreciation of that asset that was disposed of from the time it was acquired up to the time it was disposed. These are the expenditures that you're going to incur to repair are not added onto that. They are revenue expenditure. They are expensed. Okay. I feel like I want to go to suspense accounts and collection of errors. Yes, sir. It's 2024 December. What? Hey, you man, you want to give free marks? What are some of the causes of depreciation? Free marks. Make research, I think, on those ones, but they're easy. Eh? Causes of depreciation. Can someone help this gentleman with some free marks? Causes of depreciation. See, the challenge is, level 1 students, you don't want to research, but when you come to level 3, you learn what. Because you can't get notes. What are some of the causes of depreciation? Causes of depreciation. Can someone give us? That's one. Obsolescence. Two. Wear and tear. There is obsolescence. There is accident, which your neighbor has just mentioned. There is expiration of certain rights, legal rights. Maybe you had acquired that asset through a lease. There is depletion assets. What is it called? How is it called? Okay. Which question can we do that has time apportionment? I really wanted to try out one question for you guys that has time apportionment. I just wanted to hint on the depreciation. I may not do the entire question because time has really gone, because we have parts.
Hello?
Yes, please.
Yeah, a quick one, just to throw more light on the expenses during the disposal. Meaning that once considering the cost of the asset, stroke of evaluation, then considering the accumulated depreciation, also considering the actual proceeds of the very asset. If there are other expenses that are revenue expenses, in your explanation, you are confirming that these expenses won't affect gain on disposal, right?
Were you adding on or you are asking a question?
No, I'm asking because once they are revenue expenses, meaning that these can't touch the disposal account, right? I'm just asking to confirm.
I didn't get your question very well. You're saying that what?
My question is
Okay.
that during the disposal process,
Yes.
and you incur some expenses to ensure that actually any asset is in a state that is actually sellable, in a sellable state.
Yes.
And such expenses can't be capitalized.
No, they are revenue expenses, so they are supposed to be expensed.
Meaning, okay. And my question was that considering the cost stroke revaluation of the asset, okay, and its accumulated depreciation plus the disposal proceeds, I may get a gain or a loss. Won't those other expenses affect the gain or loss in one way or the other?
No. The gain or loss on disposal are just simply for you to ascertain, did you sell your asset at a loss or at a profit? Okay. Now your cost of the asset does not change, irrespective of the fact that you incurred some repair costs after it was involved in an accident. Okay. Because those repair costs, you do not capitalize them, you actually expense them. Now, should you sell your asset at a profit, for example, the first thing would be, did I recover, first of all, my costs that I incurred to repair this car?
Okay.
That is the mindset.
Yes.
Yeah.
Yes.
So it's not that you're going to compare those costs that you incurred and you added them onto the original cost. No, because under the accounting perspective, the asset was disposed of immediately. It was involved in an accident. That's what this lady was asking. Yes. So the disposal point is the accident. And if you look at this gentleman's question, the causes of depreciation, wear and tear, obsolescence, accident is one of them. Because at that point in time, the asset's functionality has been reduced by the accident. Yes, that is it. Okay.
Thank you so much.
Let's try to. I'm just going to try to interpret, guys. I'm not going to do this whole question, just to give you perspective. Okay. I just want to show you how can we compute time apportionment. So this is what I am going to do. Okay. Wait a minute. This is what I'm going to do. Let's first go to the required parts. They are saying, explain the purpose of depreciation and the 3 advantages of computing depreciation. That one you read through. Prepare for the years 2020 and 2021. Now, here they gave you only 2 years. A combined assets account, accumulated depreciation, and then the disposal account. Now, when you look at the additional information 1, it was just the question. So, if at all there are several assets, for example, maybe that are disposed, okay? If at all there are several assets that are disposed, so this is what I'm going to do. I'm going to compute for one asset. Yeah? Should there be another one, you will complete. Agreed? Okay, so you had a question. A gain or loss on revaluation, all these things, you should be able to read them in your theory as you read debit, credit. This is the asset, because the asset has increased in value. Okay? This one is taken in other comprehensive incomes. Remember, the statement of profit or loss is called the statement of profit or loss and other comprehensive income. That is your double entry. If I told you revalued it upwards, that's now the gain. If it is downwards, now the reverse. But if it is a loss, okay? Loss on revaluation, for example, this one here. The first credit is simple. What is the credit? the asset. The debit is profit or loss as a what? Expense. See, simple thing. Financial reporting is knocking on the door for you guys. So if you're still struggling here, financial reporting is knocking. In financial reporting, we don't repeat this. Anyway, so just let's try to interpret this question very quickly, okay? Because we have to go to suspense accounts and correction of errors, right? Right? Okay. Let's try to interpret this question quickly. Online members, are we still there? Please don't drop off. Don't drop off.
Yes, we are. Yes, we are.
Okay. So they are saying, so whenever we are given a question, please let's first go to the required part. Let's read what are they asking of us, but we have gone through that. So they are saying that the following balances relate to, the following information relates to the non-current assets of Mbubu Hotel. The balances as follows. So you have the date of completion, and then you have the cost of the constructions of the assets. Okay, so you have building block A, the guest house, building block B, and then you have a conference hall. Now, which assets, now this is what they're asking you. They're asking you to prepare non-current assets max. And what are those free marks? They are the opening balances. So you have balance brought down. The balances brought down, you have on 1st January 2019, you have block A. Okay, you have block A. Block A, is it block A? Okay, let's first read through. So we have block A, you have those costs, those are costs. Then on March 2020, the demand for the rooms in the hotel increased and management agreed to make an extension by building block C. The following items were incurred. Oh, now, sir, this is where your question is. You see that? All those costs have to be capitalized. Okay? Then block C was completed and put to use on 30th of September. So let's first handle block per block. We see how we go about it, okay? So we have block A. Let's first look through what are the costs of block A. Block A. So block A is giving us a combined cost of 800,000. Sorry, yes, 800 million. So that is our block A. Yeah. So block A, we have 800. Then block B also 240. Then block C 400. How much is that? 240 plus 800 plus 400 plus 120. You see, all those are opening balances, right? So that is our opening balance that we are going to recognize in our books, okay? So we have those assets, the opening balances, that is the balance brought forward, right? Are we together? I've added all those balances. That is the opening balance for the year, because they're asking you in the required, they're asking you to prepare for the years ended 2020 and 2021. Are we together? So our balances for that year of 2020 is balance brought forward balance brought forward is 1.5, right? So we have added all those four, just for context. We have added all those four. Are we together? Okay. Now, in the year 2020, if you look at note number, anyway, let me just, so on 1st of March, on 1st of March, we constructed those block C, but then they're telling you that block C was completed in the year 2021. Okay? Then in the year 2021, management decided to dispose of the guest house. Okay? Then it is the company's policy to depreciate building. So it means in the year 2020, there were no assets that were added. Are we together? So it means that by 31st December 2020, our balance carried down was 156. We are together? Yeah? So we close off. Now this is the assets account. 1st of January 2021, balance brought down is 156. We are together? Now, let's read now note 2. Note 2 is saying that they made an extension of constructing block C, an extension to block C. But read note 2 in line with note 3. They are saying that block C was completed in 2021, meaning it is in the year 2021 that we are adding a what? Another asset. Are we getting that? That is 30th of September 2021. We are calling it what? Block C. We are together? Now, the question is, which costs are we going to include as part of our costs to construct block C? We are together? Huh? Okay. Now, can we look through those costs and we decide which one is coming into the cost of block C? Plan for extension, architecture fees. Are we capitalizing or we are expensing? We are capitalizing. That is one cost. Next cost. Labor paid for the construction, you're capitalizing. Next. Yeah? Building materials, you're capitalizing. 3. So 4. Permission fees, you're capitalizing. 5. Insurance, you're capitalizing. Have you got them? Yeah? So, in other words, you're going to get the 2.2 plus the 800 plus the 167 plus the 28.5 plus the 1.5. What is the cost? What's the total? Yes, sir. Do we capitalize? This was insurance to cover construction works. Now he's asking, do we capitalize all types of insurance? Now, the answer is no. Now, where you're heading, third-party comprehensive, what? There are people who may not know those things. Maybe you're in insurance business. I don't know. But here is what you need to just be mindful of. If at all they're telling you, let's say we shipped a vehicle from Japan to Uganda, you're going to cover insurance for that. That one you have to capitalize it, okay? But if at all they are telling you that you paid for third-party insurance, third party is just like cover to help you move. It does not add on to the cost of the asset. That one is going to be expense. So what is our total cost for this block C? Which other ones? Other operating expenses. The question is, Do you know the difference between revenue expenditure and capital expenditure? What's the difference? Because that's where your question is. And I started from there. So here is the thing. This is what I told you. Whenever you're looking at assets, the first thing you need to ask yourself, do I know? And they normally ask that question and they give you 4 marks. Distinguish between capital expenditure and revenue expenditure. Giving examples. Have you seen that question before? Because the question you've asked, I started with it. Now, revenue expenditures are those expenditures that are expensed. They don't form part of the cost of the asset. Now, here they're telling you other operating expenses. They're operating. In other words, they are incurring these expenses to operate the business. If these expenses were specific to the building, they would have told you that they were what? Specific to that building. So the 6 million you're talking about, you're going to expense it. Now, the challenge is some of us get excited when they say figures in the question. We think that all figures they give us, we have to use them. Are you getting it? The answer is no. So unfortunately, you have to make the decision yourself. Which figures you think you want to use and which one you will not use. And it's not very far. By this time, we would be... By this time, we would be doing our last question. Not so. Yeah. Anyway, just know the difference between revenue expenditure and capital expenditure. You'll be good to go, okay? Yeah. So what is our cost for this? 200,000. Members, I hope we are together on how we are getting this, the 200. Now, the question is, in the year 2021, is there something else that happened? We go to which note? Note number 4. You see? Note 4. On 1st of December 2021, management decided to dispose of the guest house business and also buy the remaining plot of land that contained a building to allow for expansion. The building housing the guest house business was disposed of at 340 million. Those are the sale proceeds, right? Management topped up 29.6 on the proceeds received to acquire a new building plot of land / building and named it Block D. Block D was acquired in the same day, 1st of December 2021, that the guest house was disposed. Now, in this transaction, you have 2 things. Yeah? You have an acquisition of a new asset and you have a disposal of an old asset. But the new asset is being acquired using 2 components. Using the proceeds of the previous or of the other asset and a top-up. Are you getting that? So that is another thing that we need to be mindful of. So now, when you dispose of an asset, these 4 steps start coming into play. You see, these 4 steps that we looked at, dispose of an asset. These 4 steps you have now to start planning to use them. Are you together? Yeah? So on the guest house, we are going to use these 4 steps. So let me just have this. So when was it? It was 1st of December 2021. We disposed of a guest house. Now, that guest house, when we dispose it of, that guest house, we are going to debit what? We are going to debit the disposal account and credit the assets account. You see that? So here we shall have disposal. And in brackets, it is called what? The guest house. The question is, we are disposing it off at what? We are disposing it off at its cost price. What was the cost of this guest house? 240,000. You see that? Now, when you open your disposal account, you expect you to pass the debit, right? But before we go to the disposal account, in the same year 2021, we had an acquisition of a what? Of Block D, right? Block D. Block D had two components, the 340 and the top up of what? Of 20, what was it? 29.6. So what is the total cost of Block D? 369,600. You see that? So this is the top up plus the proceeds of Block D. The number is finished. Because in other years, we don't have any assets to add, right? So in the assets account, you get 31st December 2021. What is our balance carried down? Now, when it comes to adding, there are some people who forget this. Yeah? People tend to add this and this and they forget the opening balance for that year. So please, you need to add all those three components. Subtract the other 240 and get the balances. This is the assets account. I hope you are done. Yeah? Any questions? Yes. She's asking, when we acquire an asset, but we start using it at a later date, which date do we start computing the depreciation? The asset starts to depreciate when it's available for use. Available means, is it in proper condition to be used? For example, when you buy a car and it's functioning properly and you park it, but you start using it 4 months later, depreciation starts on the day you parked it, because it's in its what? Proper use, available for use. All those things are in your, I don't know which reading materials you're using, but they should be in IS 16. Okay? Should be in IS 16. So this is the assets account. No question? I move on. Okay. Now, in your disposal accounts, let me first go to disposal. In your disposal account, this is what I expect. I expect here to find a what? A guest house to complete the double entry, right? 240. You see this? 240. Debit and the credit is there, right? But in this same disposal account, I expect to have sale proceeds. We received some money. How much were they? We received the proceeds of what? Of 340. You remember? Now, the question is, what next? There is step 2. Step 2 says, transfer the accumulated depreciation of the asset disposed of to the disposal account. Now, you have to compute the accumulated depreciation. Now, that is the nightmare for candidates. Accumulated depreciation is the nightmare. You want to rush doing that account, which is wrong. When they give you multiple accounts, please don't rush. Handle asset per asset, because when you rush, you will not get it correctly. So let's first look at note number 5. Note number 5. It's the hotel policy to depreciate all buildings at 5% per annum on cost. Which method is that? Straight line. On a time apportionment basis. The financial end 31st December. Now this is easy. So let's get our assets that we are going to depreciate. The first thing, we are going to depreciate the assets for the year 2020. Now, please note, they have not told you that depreciation is ignored in the year of disposal. Some of you like to assume that because the numbers that you do more, They say ignore depreciation in the year of disposal. Some of you take it even in the exam. Are you getting that? Now, this one, they have not told you to ignore depreciation in the year of disposal, meaning in the year 2021, when you disposed of this guest house, you have to depreciate it. Are we together? Please don't assume that depreciation is ignored in the year of disposal. Once you do, like they say, kabaka with them. So let's compute. Let's compute. So we have accumulated depreciation account. Accumulated depreciation account also has to be drawn up. Accumulated depreciation account. Do we have an opening balance for it? 2020, because we are asking us to prepare for 2021 and the like. So in the year 2020, can we compute our depreciation? What do we have? So balance brought down. How many assets do we have? We had block A. We had the guest house. We had block B. And then we also had the conference hall. So those were the original assets that we had. Okay. The question is, when did we get them? We got them. We got them in the year. Which year was it? 2019. So we have to compute from 2019. You see that? Because remember, the depreciation of the year 2019 is going to be our opening in the year 2020. Yeah? So we have to compute for 2019. So let's move on. So in the year 2019, when did we have that? Our assets. So we had our assets. So in the year 2019, the question is, are we going to depreciate for a whole year or for a shorter period of time? For 2019, is it a whole year? Yes. So we have our assets. So let's compute the depreciation. So block A first. Block A. What is the rate? 5%. What is the cost? 800,000. What is the depreciation? 40,000. Next asset is, this is block A. We have what? What? The guest house. 5% times 240. What is the depreciation? 12,000. Next. Block B. 5% of 400. Yeah? 400. What is the amount? 20,000. Any other? Conference hall. Did we have the conference hall in the year 2019? It was acquired on? Block B was acquired on the 31st of March 2019. So that's what I was asking you. Is it a full year or not a full year? You see that? Now that's what time apportionment means. So you have to be very keen to look at the date. So block B, we have 5% times 400,000 times what? Pardon? 9 out of 12. Okay. So what did we get? $15,000. Okay. So the conference hall, we shall start multiplying it the other year, right? So how much do we get here? We have 67,000. We have 67,000. 67,000. So this is 2019. So 2019 is going to be our balance brought down for the year 2019. We are together? No. Yeah. No. It is the subsequent year. I remembered when I was out. I think there's a gentleman who asked that question online. Yes, when the asset is acquired on the last day, you start computing depreciation going ahead. Yes. So I think he gave an example of 2025. So you're supposed to compute depreciation on the 1st of 2025 for that example he gave. So this conference hall, we shall start from 1st January 2020. Yeah. So our opening balance for the year 2019 is 67,000. So now, you have not yet answered the question. We just wanted to know what is our opening. Now, in this 67,000 that we have just computed here, our major interest is what? This guest house. Okay? Please keep in mind that your interest is the guest house. Now, we turn our back to 2020. 2020, the same thing. Okay? 2020, the same thing. You have block A, which is now 5% times 800. Nothing is changing, right? Block, so we have the guest house. 5% times 240, which is now again how much? 12,000, right? Then now we have block B. Block B is 5% times 400,000. Are we apportioning still? Now, this time block B is the whole year, right? Times A, it's a whole year. This is what? 20,000. We have the conference hall. 5% times what? Times 120. Times 120, right? Times what? 120, yes. How much do we get? 6,000. Any other asset? So this is the depreciation for the year 2020. Now, because we are going to have to transfer the accumulated depreciation of the guest house, it's better you now recognize it individually. Okay? So for the year, so now depreciation for 2020, we have for block A, which is 40,000. We have for the guest house, 12,000. We have for block B, which was 20. And then we have the conference hall, which is 6,000. What is our total in the year 2020? What is our total in the year 2020? 145. We are there. Huh? That is it. Now, you go through the same process, but now for the year 2021. You get it? Now, I will not finish. Let me pick out one asset that I'm interested in just for illustration purposes, okay? But please make sure that you go through other assets, just like we have done, okay? Let me only pick out the guest house, because that's what I need, yeah? Okay. Can you compute for me the depreciation for the year 2021 for the guest house? Here. So this is the year 2021. I need the guest house. What is the depreciation for the guest house? Did they tell us to ignore depreciation in the of disposal, or they didn't? Are we ignoring depreciation of the guest house in the of disposal, or we are not? We are not. So what is the depreciation for the guest house? It is 5% times 240. Times 11 out of 12. Now, this is what we mean by time apportionment. You see this? How are we computing the 11? It was disposed of on the 1st of December. So we are computing from January to November. How much do we get? 11,000. You see that? So we are going now to recognize this 11,000 here. Okay? Now, you're going to compute for the other assets. Of course, we have block A, block B, and then the conference hall, right? To put them here. Now, we go back to our step 2. Step 2 says, transfer the accumulated depreciation of the asset disposed of from the accumulated depreciation account to the disposal account. Okay? Now, our question is to add, by how much has the guest house been depreciating? So we're going to add 2019, 2020, 2021. None, sir? Yes. What is our total? 2019, 2020, 2021. 35. Are we together? So we are now going to remove that 35 from this account to the disposal account by debiting accumulated depreciation, in brackets, this is guest house, 35,000. And then we go to our disposal account and credit accumulated depreciation, 35,000. See that? Debit and credit. We are together. Online members, I hope we are still together.
Yes, we are together, sir.
Okay. Now, our step 3 was to recognize the sale proceeds, right? We already captured our sale proceeds, which is what? 240. Yes, sir. What if the balance for the accumulated depreciation? Which one? This 67. Yes. Was if it was given to you as a whole figure? Yes. What do? You go through what we have done here. You compute independently year by year so that you get to know what is the makeup of that 67 if it was given to you. You first establish what is the makeup, because when they give it to you as one figure, you know that it has several assets in it. Yes. So you go through what we have done so that you break it down until you pick out what you are interested in. So our step 4 now is to determine where we have a gain or a loss on disposal. So we are going to compare our net book value with the sale proceeds. What is our net book value? 240 minus 35,000. Non so? What do we get? Our sale proceeds is 340. So what are we getting? 205,000. Like this. Huh? 2,500. Sir, this is why your question was. So after you've got your net book value as this, and you have your sale proceeds, now you determine whether you have a gain or a loss on disposal. So, do we have a gain or we have a loss? So we add our total. This is 375,000. 375,000. So our gain on disposal is how much? 135. That is how you can enjoy your free marks like that. Now, are you seeing how we have done this asset? This one asset. If there is another asset that was disposed of, please you go through the same process. Do not have balance carried down in the disposal account. Okay? Don't have balance carried down. You either have a loss or a gain. The gain will always be on the debit side, the loss will be the credit side. So if you have another asset, you also go through the same process. Can we switch to suspense account? I'm now going to move fast in this last 1 hour. I'm going to now move very fast. I'm going to just be hinting on things. Suspense accounts, what else? Yeah? Bank reconciliation. Bank reconciliation, before I hit on it, do you know what causes the discrepancy between the bank and the cash flow? Okay. Or I leave suspense accounts.
No, we pass through it.
We pass through the whole syllabus. Even if they give us 4 days, still you will have more things. So let's try to use the remaining 1 hour. We see what to do. Now, suspense accounts. Now, personally, this is what I know. I don't know about you. Candidates don't like that question. I don't know why. Yet it's one question that is relatively easy in terms of okay, once you know your double entries very well, then you're good to go when it comes to correction of errors and suspense account. If you know what to debit and what to credit, then you are, honestly, you're very okay. Now, correction of errors and suspense account comes from the fact that the trial balance has failed to balance. Okay? Now, when the trial balance fails to balance, you have two things. You have errors. Okay? Now, those errors, you're going to look at errors that may affect the agreement of the trial balance and errors that may not affect the agreement of the trial balance. Errors that do not affect the agreement of the trial balance will still balance, but it will have what? Mistakes. Now, for the errors that you identify when you're correcting them, and you realize that those errors do not affect the agreement of the trial balance, those errors are simply corrected through a journal. I've now seen you how to do a journal, right? Debit and credit. Are you together? But please note that that journal has to balance the debit side and the credit side. There are some journals that you may pass and the debit side has 3 entries and the credit side only has 1. Yeah? As long as the amounts are the same, that journal is balanced. So don't look at that debit and credit should only have 1 entry. No, it's just about the amounts. 2, the errors that affect the agreement of the trial balance, those errors have to be corrected through suspense account. Now, another thing, suspense account should never have balance carried down. After you've corrected those errors, the suspense account should be self-balancing. That is the same thing that happens in your bank account when you're doing realization of partnerships. The bank account should be self-balancing, no balance carried down. Because the realization is what? The company is what? So the partnership is what? Is being dissolved. So the bank account should be self-balancing. So even suspense account at this point should be self-balancing. Now, the issue is you now need to know what errors affect the agreement of the trial balance. Please, by definition and examples, because they will ask you a question, distinguish between error of original entry and compensating errors. But because you only concentrate on the computing, you leave those 2 or 3 marks. You see? And I told you, the theory, as you do your theory, we were at 46, now we might be at 40, yet we have not even done any computation. We are still on theory, right? So please make use of the theory. Now, the correction of errors and suspense account, that is how you correct them. Of course, the thing is, they will give you errors when there is a problem of double entry, mathematical errors, and so on and so forth. What else do I need to talk about? Suspense. I do a number. That's what you are waiting for. Yeah? The redrafted trial balance, come on, it's the easiest thing now. You just look at what you had initially, minus the error or plus the error. That is the honest thing. Unless you want me to do a question on just how to correct the errors and suspense account. Huh? Or I move on. Please, let's interact, but just know by 6 we are done. Tell me what I should do.
Please do a question on errors.
So these guys physically are telling me I should move on. Online, what do you think I should do?
Please do
Because
a
we need to
question on
balance.
errors.
We also suggest.
Please do a question on errors.
I do a question on errors.
Exactly.
Okay.
Yes.
What question can I do on errors? Okay. I didn't get your question. What is this saying? Worried that I didn't get this thing. Some common error. I didn't get that. A question on errors. Okay, I do a question on errors. Okay, which question? March 2022. Okay, he's saying I do March 2022. March 2022 question number. Okay, March 2022 question number 6. That's what you have said. March 2022 question number 6. March 2022 question number 6. I'm going to try to move a bit faster. March 2022 question number 6. Now, when you look at this question, so journal entries to correct the errors. Okay, so you draw up your journal entries and then you also do your suspense accounts. Okay, so that you do them concurrently. You do your suspense account. So they're telling you that prepare for TIK Limited for the year ended 31st December 2021. Okay, journal entries to correct the above errors and then the suspense account. and then the corrected net profit. Now, when you go through note number, the information they are saying that the bookkeeper of TIK Limited prepared the trial balance for the year ended 31st December 2020, but the trial balance did not agree. The credits exceeded the debits by 3,661,350. Now, when they give you such a statement, the difference, now that is the difference in the trial balance. So that difference in the trial balance, we expect you to post it to the suspense account. On which side? On the credit side or on the debit side? On the debit side, because they're telling you that the credits exceeded the debits. This is 3,616,350. Okay? Now, when you're correcting these errors, please, you need to know the errors that do not affect the agreement of the trial balance, you correct them through a journals. The errors that affect the agreement of the trial balance, you correct them through suspense account. But please note, you must know your double entries very well. Now, for you to correct the errors, you need to know three things. Number one, what entry was posted in terms of debit and credit? What entry was posted to do that error? Okay? Then two, which entries should have been done correct? Also debit and credit, right? And then the third step is now to correct the errors. Are we together? In those three steps, you must know debit and credit. If you're still shaky on debit and credit, please go and read. First, understand your accounting properly before you attack this question. Because should you attack it when you're still shaking debit and credit, you're going to mess the whole question. Are we together? But the beauty with suspense account is this. Once you know your debit and credit, you can do this question in 20 minutes and you're done. So it is a question that helps you to save time. So I encourage us as much as possible to try it. So let's move very quickly. So the draft statement of profit or loss showed a net profit of 15.6 million. Now, these are the issues that we found. The balance due to one of the suppliers, Yukovo Enterprises, was overstated by 1.4. First, tell me, what are entries? The balance, please don't first go to how you resolve the error, follow how I've guided. First, to know which entries do you think were affected by this? And then which entries do we need to do? And then we shall correct. That is a simple logic. Because if you go directly to suspense, some of you like suspense. You put suspense in all the transactions before you interpret it. You put suspense everywhere, suspense, before you actually internalize what you're dealing with. Are we getting that? So they're telling you that the balance due to one of the suppliers, that balance is due to who? To Chikubo. Are we there? Who is supposed to pay Chikubo? TIK. You now. So in other words, that balance due to Chikubo is overstated. So in other words, my question, maybe to make it simpler, is it assets are overstated or liabilities are overstated? Liabilities are overstated. Are you seeing the interpretation now? Becomes easy. Now the second question is, how do you reduce liabilities? By debit. You're saying you double. How do you reduce liabilities? You debit. Have you seen one entry now? So post a debit in your journals of Chikobo. Of how much? 147,500. So that you reduce it. Now, another thing. Now, how does suspense account come in, if any? Suspense account comes in ways. Number one, when there is errors of casting, undercasting or overcasting. Two, non-compliance to double entry. Now we have a debit, there is no credit. You introduce in what? Suspense account, so that you comply with double entry. Are we getting that? So you introduce in your suspense. Now, for purposes of not forgetting, it's important, or it will be better, you post this transaction immediately to the suspense account. So that in case even time catches up, what number are we doing? Oh my God. Someone is asking, what number are we doing? We have already finished one transaction. How will you catch up? Yeah. You see? That's the question we are doing. But we have already interpreted the first transaction. I said I'm going to move fast, so please be on the alert. So we have done, so post that transaction to your suspense account. The question is, on which side? On the debit side or on the credit side? On the debit or on the credit? On the credit side. So please transfer that immediately. So we go to, this is Chikubo, 1470500. Okay, it's 2. We go to 2 is saying that the purchase of a motor vehicle, 45 million, had been debited to the purchaser's account. Which debit and credit were passed here? Tell me. This is the error. Yeah? What was debited, what was credited? They debited the purchases and they credited the motor vehicle. You see that? Which error is this? Which error is that? Which error is that? You said you know the types of errors. Which error is that? Because if you don't know those errors, that is the error of principle.
Error of principle.
Yes. This is an asset. So that is an error of principle. The question is, does the error of principle affect the agreement of the trial balance or it doesn't? That's another question. Does it affect the agreement of the trial balance or it doesn't? Now, let me tell you something, guys. Now, this is why suspense account becomes a challenge. You don't just say me, it affects. This is just one thing here. You have errors that affect and errors that don't affect. Now, you need to know the examples of those errors. That is the first trick to passing this question. It's not guesswork. Once you know these are the errors, now here where you don't affect, please note, never bring in anything called suspense account. Never. Because should you're messing up things. So that's me, it affects. Just remove it from your mind. First, get to know those examples. Once you get to know, you're finished. So this is an error of principle. Errors of principle do not affect the agreement of the trial balance. Error of omission, error of commission, compensating errors, original entry, all those. So these errors, we use journals to correct them. Now, for us to correct this, we're just going to reverse this entry. Already here, purchases are overstated. Now, this purchase was specific. They purchased a motor vehicle. They did not just say purchases, okay? It was an asset. So you looked at, so you did an asset and you posted it in another asset. So you classified a specific asset in a general assets account, which is wrong. Are we together? Another way they can ask you this question is, or this transaction, they will ask you, repair costs were debited to the assets account. Repair costs, or the assets cost was posted in the repairs account. Now the question is, do you know the elements of financial statements? Where we began from? Repairs, Is it an asset? It's an expense. Then you have a motor vehicle, which is a what? An asset. I hope you're seeing. So you need to change them. Yes, sir. What do you think they did? That's the discussion. How do you know they did it cash or bank? What if you're saying they purchased it using cash or bank? What if they purchased this motor vehicle on credit? I'm asking him because I'm asking him. Now, you were given two accounts. Now, that's another problem that you guys face when you're doing question. You want to introduce in another asset account you've not been given. You're already given two. You have purchases, you have motor vehicle. They are two assets account. Do you remember where I started from? Purchases, assets, expenses, debit, incomes, equity, or what else? Liabilities, credit. You see that? Now, you who is thinking cash or bank, my question to you, how do you know they purchased it using cash? That's why I've asked you, what if it was acquired on credit? No. That's why I told you errors of principle do not affect the agreement of the trial balance. Exactly. They don't affect the agreement of the trial balance. In other words, the trial balance will still balance either way, whether you perform that entry or you do not perform that entry. The question is, how much was 45? You reverse it. Now, when you reverse, this is what you're going to do. When you reverse that entry, you're canceling out the purchases and you're recognizing the assets by debiting them. Should they want to give us more information, whether it is cash or bank, that's another business. But for us in areas of principle, we are simply, we call it calling out. In other words, we want the motor vehicle to appear in black and white as it is in its own account. I know where you're coming from. Hey, I know. Suspense is tough. You see, the thing is, do you see that line? Purchase of a motor vehicle by 45 had been debited to the purchaser's account. Some of you read that line as if you're reading lyrics to a song. You just read it at once and you proceed. Now, in suspense account, it's different. You first read it like that, then you read it again, but now when you are breaking it down in bits so that you interpret one bit. That's how we read it. So let's post the debit. I'll show you other entries as we move on. You'll see that please don't introduce in foreign material. For you want to introduce in foreign material. Are we together? So let's post that and then we proceed. So we have, here we have what? Motor vehicle. And then we have what? Purchases. Now, my friends who want to sing suspense every transaction, I hope you're seeing now that not every entry must have suspense. Carriage outwards of 2.1 had been credited to the return outwards account as 215,000. Can someone online tell us the problem there? The issue is first seeing what is the problem. And if you don't see the problem, the resolution is going to be hard. Can someone tell us what's the problem there?
Kindly repeat the question, kindly.
Hey, sir. I hope you're following using the question. I cannot be repeating the question. We are doing March 2022, question number 6. So I expected you to be following with me. This guy is online. Are you sleeping? You guys online. What has happened? and you started to disappear. You were over like 50. I'm seeing you're now 30 something. You've disappeared. Can someone tell us what's the problem there? Can someone tell us? Okay, here, can someone help us with the problem there?
There's a
First, leave the amount. First, leave the amounts. Someone was saying arithmetic. Yes, I see it is an arithmetic error because the amounts are there, right? First, leave the amounts. What is the problem?
There's an error of undercast.
Someone is saying there's an error of undercast. Let's first leave the amounts. Let's first leave the amounts. Okay, let me show you how to interpret this transaction, right? Look here. Carriage outwards. Are you seeing that? Carriage outwards had been credited to return outwards. That's why I want you to interpret. First, leave the amounts. The question is, carriage outwards has which balance? Debit or credit?
It has a debit balance.
It has a debit balance.
Side.
Once you recognize it has a debit balance, you've passed the transaction. Return outwards has which balance? Credit. Once you interpret that, you've passed. Even if I stop here, you've passed. If you're not able to see that carriage outward is supposed to be debit and return outward is supposed to be credit, you're finished. I show you how? You'll be finished. This gentleman is looking at me with miserable eyes. That's like I am finished now. You're not finished. That's why we are here. Here's what I'm trying to show you. You have two accounts. You have carriage outwards and you have return outwards. Return outwards is supposed to be credit. Return carriage outward is supposed to be debit. Now, here's what they said, that carriage outwards of 2.1 had been credited. In other words, what you should expect as a debit here is missing. You see that? Is missing. We are together. In other words, this carriage outwards of 2.1 is missing. It's not there at all. So that's the first problem. Now, the people who are only focusing on the arithmetic, the undercast people, let's bring you also on board. However, this is what they did. Instead of posting it as 2.1, they went ahead and credited it as 215. So you have two problems. You have a missing entry, which is an error of omission, right? And then you also have an entry that was posted, first of all, wrongly to a wrong account, but then also to a wrong, but then also with wrong amounts. Are we getting it? Now, here's how we are going to solve this error. First of all, do we all agree that we have to post the debit here? Have you seen that? So let's go to our journals and say carriage in. So carriage outwards, which is what? 215. Are we together? I hope you have all understood that debit. Have you understood that debit? Perfect. I proceed. Now, we have a 215,000 to return outwards. The question is, were we interested in the return outwards account? No. So the answer is, we needed to close this account. How do we close this account? We are going to pass a debit. So that the debit and the credit do what? We are saying, cancel. We come. Hey, they are interesting when we are together. This is return out 215. We have sorted our error. We have debited the return out, the carried outwards, which we should have done, right? We have cancelled out return outwards, which was posted wrongly in error, right? We are finished, right? We have finished sorting the errors. But if we leave it at that, we will be committing another error, which is a single entry. So we have a debit, we have no credit. We bring in our suspense account with the what? The total. It's hard, eh? It's not hard. So what's our total? This gentleman is not understanding himself. You're shaking the head. What's the problem? Yeah. Okay. Did I do any magic here? I was just interpreting, right? I was just interpreting. Did I do any magic? No, I was interpreting. So, what's our total?
4.3.
2365. Now, when we go to our suspense account, you split the two, okay? Split the two, come to your suspense account and say, carriage outwards, and then return out, which is 215, and then the 15. Okay, we're together. Transaction 4, please deal with it. The sales account was overcast by 345, meaning the sales account was what? Was what? The sales account was what? Guys, you speak up. You're doing revision. You should know these things. It was overstated. So how do we reduce it? By debit. So we are going to debit sales. We are going to debit sales with what? 3450200 and credit what? Suspense. This was an error of casting. 345,200. This is sales. So sorry, 345,200. I've shown you what to do, right? We switch something else, or you want me to finish? I've shown you what to do, right? You have a question, sir? 1 minute on the net profit. Now, on the net profit, on the statement of net profit, here is the interpretation. What you need to know is this. Whatever affects the net profit positively, you add. Whatever affects the profit negatively, you subtract. For example, they said that the sales were overcast by 3.4. That is not number 4. Meaning, for you to generate that net profit of 15 million, they had overstated the sales. So the question, do you add or you subtract? I'm asking this gentleman. You add or you subtract? You subtract. Because to generate that 15 million, the sales had been overstated. Okay? 2, the purchases, the other 45 million we looked at. By that time, the purchases had been overstated. In other words, what is the impact of overstating purchases on your profits? Remember, purchases is part of cost of sales. So in this case, we are going to add the purchases because when the purchases were high, the cost of sales were low. So we reported a high, so we are going to add it back. So that is the impact. So you analyze it like that. And how do you get them? You get them using these journals that you're saying. Yeah? Carriage outwards, for example, that we have just done, had not been recorded at all. Yet carriage outwards is an expense, right? Now, in the statement of corrected net profit, you have to recognize that what? Expense. By doing what? By subtracting. Are you seeing? That's how you do add and back. Suspense, bye-bye. Next topic, what else? Bank reconciliation. What's the problem there? Under bank reconciliation. Under the bank reconciliation, first things first. Online team, are we still together?
Yes, please, we are together.
Joseph, today you didn't sleep.
I'm ever sober.
I think you started feeling the pressure. But don't worry, don't allow pressure to come to you. Don't allow pressure to come to you. We still have time. We still have some 2 more weeks to go.
Time has gone, my
The pressure don't allow it to come. We still have 2 more weeks to go. Now, under bank reconciliation, first things first, you need to know that we have a cash book, we have a bank. The cash book is maintained in the organization, the bank statement is maintained with the bank. Now, each of those 2 parties has a debit, has a credit. Now, in the cash book, the receiving side is the debit side. The losing side is the credit side. But in the bank, the receiving side is credit. The losing side is the debit. Are you getting that? Now, when you are doing bank reconciliation, you need to know that when you're reconciling the debit side of the cash book, you're going to reconcile it with the credit side of the bank and vice versa. So, what are the causes of the discrepancy between the cash book and the bank statement? Okay, we know those things. Unpresented, we know them, but explaining them, that's where people just touch their foreheads. But explaining them, that's the thing. Anyway, I think we shall just know how to explain them. So please read. Unpresented checks, uncredited checks. Those ones, in simple terms, they are in the cash book, but they are not in the bank. So that means that when you're doing your reconciliation, the unpresented checks, you add them. The uncredited, you subtract. The direct debits and the direct credits, in simple terms, they are in the bank, but they are not in the cash book. So when it comes to the cash book, the direct debits, you subtract. Yeah? Yes. No, you add. Is it add or subtract? You subtract. Then the direct credits, you add. Because direct credits is money that was received by the bank, but has not been received by the cash book. So those are some of the things that you need to know. Clerical errors. One thing you need to know that bank reconciliation is set with errors. Not the suspense errors we have looked at. I know some of you will not want that. But the arithmetic what? Errors. So when you're doing your reconciliation, the first thing you need to do is ensure that there are, first of all, is there compliance to double entry? That's the first thing. The second thing is if double entry is okay, are the amounts okay? Now, if the double entry is not okay, but the amounts are okay, then we know what to do. We just reverse the entries. Now, another thing we need to know, of course, there's also some theory in bank reconciliation, but when you're doing the reconciliation, just know your balance as per your reconciliation statement in the bank should be the same as the bank balance in the question. Are we together? We also need to do a practical on that. Huh? Online members, you've gone mute. I do a question on bank reconciliation. Okay. What else? Incomplete records. What's the challenge with incomplete records? I'm feeling so hot. What's the problem with incomplete records? Please speak up, speak up. Time is moving. Determine the credit sale, determine the credit purchases. You open up the control accounts. You open up the control accounts, open up the debtors control accounts, open up the creditors control account. The issue is you not knowing how the control accounts look like. But that is, so the control accounts, the receivables control accounts, receivables control accounts, as you know, it has balance brought down. We expect the carried down to be this side. Okay. Here we shall have bad debts, if any. We shall have cash or bank that the debtor has paid, if any. We shall have discounts allowed, if any. Okay. Then when you add the balancing figure here, the balancing figure, this is the balancing figure. This is going to be your credit sales, and you're done. If at all you had cash sales, you get those cash sales, add them to the credit sales, and you get the total sale. Please note that this concept of control accounts might be used in any other topic. They might give you to prepare normal profit or loss and financial position, and they don't give you the figure for sales. Why you have to derive it? Using margin and this. So don't think that this concept only applies to one topic in complete records. No, it might apply even to other topics. So just know how to derive it. Now, are we done with this? Yeah? We are done. Now, the creditors control account or the payables control account. For that one, it's now the reverse. The balance brought down is on the credit. The balance carried down is on the debit. Then here we might have cash or bank paid to suppliers. We have, I didn't put return inwards here. Return inwards also goes here. Then we have return outwards. Then we have discount received. The balancing figure here is your credit purchases. That is it. How do we treat the markup and the margin? The markup is gross profit. Markup is gross profit expressed as a percentage of cost of sales. As a percentage of cost of sales. Now, they may give you, let's say, markup is 20%. Okay? Markup is 20%. So, what you'll do, you'll have to come and say, markup equals to gross profit divided by cost of sales, right? Then, if markup is 20%, and we have our gross profit over cost of sales, we shall cross multiply. So we shall have our gross profit is equals to 20% cost of sales. Cost of sales, right? So, but what did they say? They said that sales minus cost of sales gives us gross profit. So wherever there is gross profit here, we are going to substitute this. Is that okay? Let me do it again. Where gross profit is, now let me show you. You have sales minus cost of sales. Ideally, I should have gross profit, right? But instead of putting gross profit, I'm going to substitute it with 20% cost of sales, right? Now I want to collect the like terms. Cost of sales on one side, sales on the other side, right? So I'm going to have sales equals to 0.2 cost of sales, right? Cost of sales. You know, 20% is the same as 0.2, no, sir? Now, this cost of sales here, this cost of sales was a negative, okay? When it crosses the equal sign, it becomes a what? A positive. No, sir? So, I'll have sales equals to 1.2 cost of sales. Now, once I have the figure of cost of sales, I just multiply and I get the sales. Are we together? You do the same for margin. Now, wherever there is markup, here I've used the markup. Now, the same applies to margin. Now, margin is going to be gross profit over sales. The way I have done them here, you just cross multiply. Now, here, instead of having gross profit is equals to 20% cost of sales, I'll have gross profit is equal to 20% sales. No, sir? Yeah? Are we together? Madam, are we still together? Or you finished? For the margin, have you understood the markup? Okay. Here's what I'm trying to say. When they give you margin, margin is gross profit over sales. Markup is gross profit over cost of sales. So here, where I did 20% equals to gross profit over, here I substitute for sales, not cost of sales, okay? Then I cross multiply the same thing. Now, instead of having gross profit equals to 20% cost of sales, I have gross profit equals 20% sales. Now, I say sales minus cost of sales equals to 20% sales. Are we together? Now, I will make cost of sales to be the subject, and then I will bring the sales together. So I'll just say sales minus 0.2 sales. And then the fraction I'll have will be like this, 0.8 sales equals to cost of sales. And then you multiply the figures. Are we together? Just the same concept. Yeah. So that is what I had prepared for you. Now, guys, for the exam, what you need to know is this. When you're given those question papers and they tell you start reading, because you have 3 hours and 15 minutes, 15 minutes should be for reading. Please use those 15 minutes to read section B. Use the 15 minutes to read section B. The first thing as you read section B, go to the required parts. First, understand what is required in those questions. The required. Now, after the required of all the 5 questions, because remember, there are 5 and you're supposed to attempt 4. So, first read the required. Now, when you read the required, you ask yourself, do I know this topic? Now, that's where now this whole process is now going to come. Do I know that topic? Now, after the required of all those things, now go back and now start reading the actual questions. Still section B, okay? Now, when they say start at 9:15, sorry, at 2:15, mostly, or 2:20, depending on how much time you took, please go and start with section A. Yes, go and start with section. Some of you are drunkards. I'm sorry to use that word. Some of you are drunkards. So you're going to be shaking with your pen. Now, section A is meant to help you to relax. Why? There are questions with answers. You don't need to think so much. Okay? There are questions with answers. It's just you to choose the most correct answer. It just helps you to relax. Now, the issue is you have 20 objectives, 1 mark each. Please make sure that you don't score below 12. don't score below 12. Because when you score, let's say minimum 12, me, I normally tell my students at least score 15. But if you score 12, you'll be looking for what? 38. In 4 numbers worth 80 marks. Are you getting the point? So anyway, the logic is, let me first give you the logic thing. You only need 50. In other words, if you get 10, 10, 10 in 5 numbers, you're passed. 10, 10, 10, including the objectives, 10, 10, 10. But because objectives, they are more marks, 20. Unlike section B, they give you half, half, half to make 1 mark. But here you have a whole mark. So please try as much as possible to have at least 15. Because there you'll be just 35. Now, in section B, because you used the other 15 minutes to read, and now you've calmed down, please make sure that section A you use maximum, don't exceed 25 minutes. Why am I saying 25? Use 1 minute per objective. But there are some objectives that may require you to compute. That's why I'm leaving that allowance of 5 more minutes. But try 25 minutes, you're done. Okay? And please remember, objectives come anywhere in your syllabus. Don't spot objectives. Now, in section B, when they tell you, remember you have a maximum of 36 minutes per question. 36, but in section B, that might be too little. So you need to pick the right questions at the right time. So in other words, when they tell you to start writing and you start with the objectives, please do not stop writing until they tell you to stop. Some of you start thinking in the exam or even things outside the exam. You start looking in the ceiling. What are you looking for in the ceiling? Do this. When you start writing a question, let's say my number 2, and I attempt part A and part B, as I start things jam, please leave and go to another question. Because when you stop using your pen, blue, black, the clock is what? Is moving. So pause, go to another question, go to another question, go to another question. Some of the people who get 40 to 50 there, they say I did not finish. First attempt, instruction number 1 says attempt. Gezako. Attempt. Okay? So, meaning first do all the 4 questions, even if you don't finish them. Remember the goal is what? 10, 10, 10, 10, 10 by 5. That is 50. Okay? Now, when you've done, if you use that clock very well, you will see you will spare 35 minutes when you've done all your 5 questions. And the 35 minutes you're coming to finish up. But if you're confident that you're going to do your number 2 and finish it in 36 minutes, please do. Okay? Questions to do with financial statements preparation. Present the answer first, workings last. Then, whenever a question like that, please don't start with adjustments. First, start with the free marks. Not everything is going to be adjusted. Okay? Prepare your financial statements, start posting things that do not require to be adjusted. So that even if that was your last number, you will not get 0. In accounting, no one gets 0 in a number. Unless really, for you, you did not even bother even giving an attempt. Okay? There's no you can get 0. Okay? So post those things. The other thing is, please get calculators that work. Some of you might buy calculators on the 7th. Those buttons are hard. You press them and the figures don't go on the screen. For you think the figures are going on the screen. No. Start using them now. The same applies to pens. Some of you are going to buy new pens on 7th. That new pen you want to use might not write. Start using that pen maybe 3 days before so that you're sure the pen is what is writing. Then the other thing is that might disorganize you. Please get to know the venue where you're going to do your exams from. Some of you have not been to Mengo. Use this week to pass there. Get to know where Mengo is. A border guy might take you far somewhere. I don't know if there are people who are going to do exams from ICEA. If all of you are Mango, please get to know where Mango is. You know, those small things can disorganize your mind. So please prepare those things. But questions to do with preparation of financial statements, questions to do with theory, please don't leave those marks. But objectives, that's where your first passing is. 15, and then you'll have 80 marks, but yet you're looking for what? 35. Only out of 8, sure. So with that said, I want to appreciate you for coming to listening to me. I know I was boring somehow, but I hope you learned something new today. Joseph, you can reach out to me about what you wanted me to assist you with.
Changes in equity.
I'll be happy to assist you.
Okay.
So just make sure that you reach out to me. I'll be able to assist you. So thank you guys for listening in. Like I said, I hope you've learned something new. I hope I've not confused anyone. What you had prepared in terms of your reading, I've not confused anyone. Okay? Yes, sir, you have a question. Yes. Yes. So he's asking, some of the answer booklets are too small in terms of length. Please don't draw any financial statements horizontally. No one is going to tilt their neck to mark your script. Present horizontal. So present it vertically. Okay? Now, if at all you write big things and your financial statements overlap to another page, it's okay. Don't draw things horizontal. The other thing is the attempting bit I was talking about earlier on. You are allowed even to ask for booklets if you want, because you've what? Paid for them. Okay? The other thing about accounting, please don't cross. Some of you cross and you draw lines. If I told you've done, a wrong thing or a wrong figure, just cross it out neatly and write on top. Don't over scratch. Just write on top. It will be visible. But try as much as possible to be neat. Because if you're neat, then your work is. You know, people who have nothing to write, or who are trying to waste time of the mark or of the examiner, they write things and they hide them by scratching them, thinking that the person will see. No, try to be neat. Because at least 98% of this paper is computation. There's little theory, okay? But please don't neglect the theory, like I said. Especially on a question that has part A, then for people who are doing straight, for people who want to do a question of bank reconciliation, they can ask you, they may give you part A with no cash book. I don't know if you've seen such a question. They can ask you to prepare a cash book for the transactions. Now, they have not specified which type of cash book, a 2-column or a 3-column. It's now on you to read through the transactions to distinguish between a 2-column and a 3-column. I hope by now we know the difference between those two. Please, one thing that people mess up is you assume you know how those things move, but on reaching the exam, you forget. First, use this week to know, how does a cash book look like? 2-column, 3-column. How does a P&L look like? How does SOP look like? Yeah? How does a partnership financial statements look like? Because you know, in the partnership, you have the appropriation account. What's the difference between revaluation and realization in partnership? In partnership, if they don't tell you to draw the individual assets that have been revalued, they are T accounts. Please don't waste time. Partnership is wide. Then two, get to know when do you use a fixed capital account method and a fluctuating, because they may give you a fluctuating. Now a person will waste time drawing the current account, yet it's not required. That's why I first say read the required first, so that you get to know. When it comes to revaluation, get to know how do you value goodwill? Which method has the examiner asked? Is it the revaluation method or the memorandum revaluation method? When it comes to accounting for non-profit making organization, for example, and that question came last year in December, chances are high it might. But if it's there, please don't forget, don't say statement of profit or loss. It is what? The statement of income and expenditure. Don't say net profit, say surplus or deficit. That is the thing. Then don't forget how to draw the subscription account. Subscription in advance, subscription in arrears. People tend to confuse those because they know their end of the adjustments. It's different with subscription. Subscription in advance is not a liability, it's an income. So please get to know those differences. Yeah? What else? Manufacturing, I think many people don't have any issue. With manufacturing, the only issue might be apportioning overheads. Yeah? Get to know if they have given you 1/4 dash 1/2, how do you get the difference? If it's 50, 30 dash, how do you get the difference? All the best on 8th. All the best, unless someone has something else to say. I kindly beg to stop here.
Thank you, Mr. Hammond.
You're welcome.
Thank you, sir.
Welcome.